Morning, everyone. Thank you so much for coming along and joining us today at SGX. Real absolute pleasure to have you. There's a really great lineup of speakers. We have four of our ETF issuers who are here to engage with you, train, and have some fun. So hopefully you get the most out of this day for everyone who is physically here, and for everyone who is watching us digitally, very warm welcome to you as well. So I've been given a task of 5-10 minute opener just to discuss a little bit about what our ETF footprint is and how that might help you through today's list of speakers. As I said, it's a long billing, and I really want to, I guess, really share what really is our most exciting updates, what is our most exciting figures, from the world of exchange-traded funds that really is, I guess, shaping the investment landscape, if you will. So I'm going to try and be a little bit bold as well, and dive into the numbers that matter, and of course, the economic outlook that's guiding the investment strategies of every investor. So firstly, the global ETF market has experienced substantial growth since I think 1990 to 1992, around the time I was at university, was the same time we started ETFs globally. So they've been around for a good 30 years or so, more than 30 years, and have total asset under managements now in ETFs at 13 trillion. For context, globally, across the world, you've got 100 trillion of GDP, and you've got around 110 to 120 trillion of global market capitalization across the stock market. So you can see there's a pretty strong cornerstone of investors that are participating in global growth and global markets from the perspective or from the lens or from the footing of an exchange-traded fund. Now, what this expansion really does, I think, reflect is increasing investor interest in economical access to diversified and accessible investment options across various asset classes. Economical, because before COVID, there was a lot of studies conducted that showed that ETF growth in terms of investor participation was very directly correlated with the reduction in fees of ETFs. That's your total management fees or total expense ratios. That was so much more competitive than the big mutual funds, the big hedge funds of the world. So I guess since the inception of Singapore's first ETF back in 2001, we've also witnessed a remarkable journey, which has been aligned with that demand for funds at a lower management fee. One of our pioneering ETFs, not our first, but one of our first, tracks the Straits Times Index, or the STI as we colloquially call it. That ETF has delivered a 6.4% annualized total return from its inception in April 2002 through to yesterday. Despite the recent challenges that have seen this return actually dip to 5.1%, that's an annualized total return of 5.1% since the end of 2019, investors who have been able to embrace dollar cost averaging have still been able to capture 80% of that total return since the end of 2019. So the growth of ETFs here, as I said, has been nothing short of impressive. Since the beginning of 2020, SGX has listed 20 new ETFs, and the combined asset under management of all our Singapore ETFs has more than doubled from 5 billion Sing dollars to 11 billion Sing dollars. And this growth, I think, is very much a clear indicator of the innovative drive of our ETF issuers like CSOP, Lion Global Investors, NICO-AM, and PhillipCapital Management, who have all been pivotal in this expansion. And as I said before here today, they're here to help educate, train, and have some fun. So ETFs don't just stand for engagement, training, and fun. They also stand for exchange-traded funds, but they also stand for efficiency, transparency, and flexibility. They have really lived up to this by allowing investors to systematically add units to their positions during market volatility, For instance, it took 17 years for both SDI ETFs to reach a combined asset under management of 1 billion Sing dollars. We saw that combined asset under management reach $2 billion in the space of just 17 months across the market volatility we saw in 2020. Focusing on China, SGX is home to 10 China ETFs that track a wide range of China equity indices. Half of these are part of the Singapore-China ETF link that are aligned with the sectors very relevant to China's multi-year economic policies. SGX also lists 2 ETFs tracking China fixed income, providing access to the not so easy to access onshore China bond markets. So China's economic outlook, it does remain cautiously optimistic. There is a big focus on long-term structural or strategic industrial policies that are very much aimed at rejuvenating domestic demand and also securing more upstream assets in their value chains. The country is also addressing the impact of its property market slowdown with fiscal consolidation frameworks, as we saw announced this week. And the property sector in China itself is expected to recover come 2026. So as I said, it's very important to take a very long-term structural multi-year approach when it comes to judging China economic policy and its impact on all the relevant parallel sectors. There's other ETFs listed here that track the United States, of course, Japan, Indonesia, Vietnam, India, and of course, a number of APAC regional facing indices that are tracked by the ETFs. And look, most ETFs look to track indices, and this is where the real innovation comes into it. And this is where a lot of excitement is in the next 10 years or so, because what we can do with indices is getting, particularly with generative AI, is getting more interesting by the day. Indices, they're all frequently rebalanced, and that allows for the inclusion of new constituents and the removal of those constituents that no longer meet the criteria or meet the bar. That ensures that all these indices, they remain reflective of the market. And this offers you as an investor a way to participate in market evolution over time. Taking exposure to evolution is really important. For instance, the STI Straits Times Index, its base date is back on 30th of December, 1966. That's when the STI was at the 100 level. That outdates most stocks here, well outdates most listed stocks. And it continues to be a reliable indicator, obviously, for the market's health. So whatever this STI composition looks like in, let's say, 2066, those 2 STI tracking ETFs will provide a means to participate in that journey. So the overall AUM of 11 Singapore billion dollars of the Singapore listed ETFs, it's not just equities and a few fixed income, as we mentioned before. It's diversified across a number of equities, REITs as well, fixed income, and of course, gold. Gold has proven its worth as a safe haven, with the SGX listed Spider Gold Shares ETF seeing a surge in trading turnover in the first half of this year and really cementing its place as a safe haven asset. So while the STI has kept pace with the regional APAC gauges since 2019, the gold ETF has actually doubled the performance of the STI and those regional gauges amid those challenges of the last 4.5 years. When you look at the distribution of AUM, which of course is very important for us as ETF portfolio investors, it's quite evenly distributed, presently balanced. When you take that 11 billion Sing dollars, you've got 39% of that 11 billion in equities, you have 8% in REITs, 40% in fixed income, and 13% in gold. And geographically, half of the relevant AUM is focused on Singapore, with the rest of the focused on the Asia Pacific region, with China obviously being the most largest component of that. So together, these Singapore-listed ETFs, they do offer investors, I guess, a gateway to participate in Asia's economic expansion, capture the opportunities in the pivotal sectors, and also those emerging themes. The emerging themes like green REITs, Asia electronic vehicles, and APAC Financials as an asset class in itself. Retail investors now hold over a quarter of that 11 billion Sing dollars of AUM, and the SRS holders are increasing their ETF holdings. They've increased it from 170 million Sing dollars at the end of 2019 to nearly or around 500 million. I think Wei-Chin said it was 501 million as of present. The avenues for ETF investment, they have broadened notably as well through advancements in fintech and the advent of robo-advisors. And robo-advisors like DBS DigiPortfolio, Stashaway, and Safe, along with regular saving plan providers such as DBS Investment Saver, OCBC Blue Chip Investment Plan, Philips Securitie Share Builder Plan, and of course the iFast RSP, they have collectively amassed close to 1 billion Sing dollars of assets under SGX listed ETFs. And look, education at the end of the day has also been a key enabler of ETF adoption among retail investors. The SGX Academy, along with partner brokers and platforms, and of course issuers, has consistently delivered education both online and physical, such as today. And look, while the year economically began with the lowest medium-term outlook for global growth that we've seen in decades, we are presently witnessing transformative economic forces. Manufacturing reshoring, AI and digital transformation, and a push for sustainability are creating new opportunities. A final word on the current state of economic forces that are really driving the adoption of these strategic industrial policies across the world is that in that adoption, countries are looking to capture more upstream value in value chains and also foster better digital and sustainable solutions. So combined, they all do offer new global policy paradigms that we can work with to navigate, build growth, and present a future that's more ripe for innovative investing strategies. So earlier this year, in January 2024, SGX did welcome our first active ETF, and that marked a significant milestone in this ETF journey. And that ETF manager has adopted AI solutions to generate alpha for unit holders. So in summary, look, ETFs, they're not merely theoretical concepts, as we all well know. They are tangible instruments that are actively shaping our financial markets. They provide investors with a practical approach to spread risk, tap into global trends, and invest in their economic future. As we continue to, I guess, to really maneuver through the complexities of the financial landscape at the moment, I think ETFs will undoubtedly assume somewhat of a pivotal role in steering us towards a market that is both, I guess, inclusive and also rich with opportunities. So let's together work to identify where the trends are, carefully assess all those opportunities, and really embrace the future of investing. So thanks very much and welcome, and look forward to joining you as we embark on this day. Thanks.
All right, thanks, Mr. Jeff Howie, on being the first speaker to introduce more about the event. Right, so once again, I'd like to introduce myself. I'm Huan Tze, I'll be the MC for today. All right, so because I've been informed, right, so not only to not lose your bingo card, which is important for your lucky draw as well as your meal ticket later, the lost and found we have is at our Phillip booth. Because what I've informed is that there's already someone that have lost your red handphone. Right, so I'm not sure why so fast. I haven't early in the morning, maybe you forget because you haven't drink coffee. Coffee is until 2 p.m. like I mentioned, right? Coffee break along the way, lucky draw, whichever. Right, so if you have already lost your items, look for our Phillip booth for the lost and found. All right, so next we do have with us Mr. Paul Chew, who will be sharing more. He's actually our head of a Phillip research team. Right, so you share more about the macro guide for ETF, and maybe you can put hands together to welcome Mr. Paul Chew. Thank you.
Is the lucky draw, so I should stop by 11:15. So for today, I'm just going to run through just hopefully a helpful guide for you on the macro situation as you select your various ETFs out there, which are numerous. So that's the picture suggests whether you're bull or bear. Hopefully, this is just a compass that will give you a guide of what's going on around globally and some pointers that maybe can help you. As usual, we have the disclaimer. I know nobody reads, but let me just summarize for you. This is for education purpose. We rely on public sources. Do refer to your financial advisor because we do not know your investment objectives, and know this just for general circulation. Okay, in terms of the content, I'll just go through briefly how the ETFs have been performing. Give you a bit of flavor of the current economic conditions globally. So this is not Singapore-centric, this is a bit more global. And then I will just give you a bit of some views on very top-down basis, how the equity markets are, bonds, commodities, why we think ASEAN's opportunity, and also with this some conclusions. Okay, anyway, I'll just run through the short and long-term performance. I will start off with the Singapore ETFs. Magnificent Seven, not by performance, and just disclaimer here. I'm thinking just about volume, because if you look at some of the ETFs, some hardly trade. You buy one ETF, some they probably call your house because no one buy. They know what you did because nobody buys those ETFs. But these are the most heavily traded ETFs, the highest volumes. If you notice, I just put the numbers on the right. This is based on since 2019 because I was just using pre-pandemic just as a reference point. And you notice that the best performing ETFs has been gold, obviously, among the locally listed ones. In the middle, of course, STI was another strong performer. Gold, you probably, from that 5.5 years, I think you probably 107, about 70 or 80% return. And you will notice that the ETFs in Singapore, just like the whole Singapore market, is very income-centric. So we have a lot of bonds, you have a lot of REITs, and these are the most heavily traded. If you subscribe to the IPO of Lion, no comment. I mean, yeah, that's the price there. But you notice that in the beginning, if you just move to your left of the screen, you notice that in the very beginning, all the bonds, all the income producing ETFs are just performing well against the STI. I won't use gold because gold. And then once the interest rates start to move, you have the pandemic, and growth started to come back, and then the STI started to outperform. Of course, the STI here is very heavy on banks, so that's one of the reasons why they tend to outperform. If you move on to, okay, I have to go outside. I have to look at just the global, just to give you an asset allocation basis, equities, bonds, commodities. So if you have bought the red one, which is the world MSCI, then congrats, you no need to stock pick, no need to think of PE, not going to do so much work, just buy everything. Then you're probably 140% in that couple of years. You're not going to have to refer to get any advice from someone like me because you just buy everything and you probably outperform everyone. Of course, bonds did well. So in the beginning, before interest rates started to rise, when interest rates were still coming down, you notice the black line, bonds and equities was more or less in line. Then, of course, when the pandemic happened, the only thing is the volatility. So when you buy equities, of course, there's a lot of volatility, and you shake a lot of people out. Usually, people don't buy when it's low, nobody buy when it's high, right? And you buy DBS when it's $30, $17, nobody want to buy. So that is the worry that if you're going to ride on equities, that this is a roller coaster. Just be mindful of that. But in general, because it tracks global growth, so it tends to outperform. If you're into commodities, just be a bit more wary because commodities have this thing called negative. I'll describe it later, but there is this thing called negative rollover yield because of if commodities contango, you roll over, it's very expensive. So even though commodities, you think commodities is the way to play global growth, good luck to you because you're on that green line. So probably equities is still the better way if you don't think economy is still going to grow, and that's the way to play it through equities rather than commodities. Then again, if you decide to buy equities and you bought US, again, you're the best asset allocator. Best, don't need to think, no need to stock pick which stock is better. You just buy the whole US market, and that did tremendously well. And of course, the yellow line is the world index, because that is largely US, so that pulled that up. Of course, not so good now if you have bought China. I think China actually did, if you look at the red line, actually China did outperform even the US. Sometimes you see the red line just pops up above the blue line. So sometimes China will outperform. But clearly, since when the trade war started, let's say 2017, 2018, you can see that China really, when this US was a bit more aggressive on China, then you notice China has started to underperform the US quite significantly, and even gone below the world. Because like I said, the orange line is the benchmark. So anything below it means that you should be buying the very least the benchmark. If you can't beat the benchmark, which is the world, then you're a big underperformer. So you can notice that China was actually quite a strong performer against the world, but once the trade war happened, then the pandemic happened, you notice the red line just totally collapsed. There's a huge de-rating, which is pretty obvious, but just to emphasize here. The one that we like because it's never performed after 20 years, so hopefully one day is the ASEAN market, because the ASEAN is grey and then it's virtually flatline, and then we'll try and give some reasons why we think. Emerging market is another category that's very heavy on China, so that's why it's also kind of underperformed. We'll talk about China later. Then we'll just run through economic conditions and what's happening globally, just to give you a flavor. This is the best part. Now, if you are an economist, you do this, just talk. I don't have to give any conclusion. Just keep on talking about how things here, how our conditions, but we'll try and give some value add and just give you some how can it help shape some of your decisions. But anyway, just to start off, just to give you some perspective how global growth has been going on, because this is a macro talk. So US growth has been stellar. So if you look at the blue line, so that's US growth. So US, of course, China was the darling. I mean, China growth was some obscene, like 25. I'm talking nominal, because this is the real, nominal pays the bills. I mean, real is for economists to talk about, but nominal is where you actually include inflation. That's the real growth, that's the amount of real money that comes out. So for that, China, of course, is overheated, 25% growth. But you notice it started to decelerate, and then even now, US has already outperformed China. On paper, you don't see it. You see in the newspapers, they talk about 2.8 because they take into account inflation. But if you talk about the real economy, that's the nominal growth. So China has clearly underperformed, and I'm not sure how to give a very bullish picture on China. I kind of gave up. But anyway, it's still going to be very bearish. I will discuss it later. But you notice that that's why the US market has done so well. We'll explain why too. Europe, I think Europe is Europe. I just go sideways somewhere. Then if you move on to, so this is quite an important chart because everyone, the US likes to bash China, but no, China accounts for around 30% of contribution. So what it means is that if the economy grows $1, 30 cents come from China. So if you want to press China down, then it's going to affect the whole economy. Of course, affect Asia even more, because this is basically contribution to GDP growth. So of course, China was the mayor. China almost 40%, almost half of all the growth in the world came from China at one point. But of course, that's not happening now. It's coming down. And now the one that's picking up the mantle or the pattern is actually US, which is the blue line. And Europe, Europe, that's what it does. I mean, just go sideways. Okay, then I'll just run very broadly, all the countries just to let you know what we think is happening. So for US growth, we think it's stalling. Of course, so first one, the most important to see where the US economy is growing is to look at US government spending. If you assume the US growing 6%, the deficit to GDP, that means the amount, in layman terms, the amount of money or growth the government is injecting into the economy is also 6%. So it's unprecedented now. So all the growth that's coming up virtually is coming from how much the government is spending. So for us, we see the deficit sliding down from very extreme levels. So that's why we worry too, because the government spending is still spent. I mean, it will kind of cap any recession, but at the same time, it is slowing. So the rate of change is coming down. if you look at all the nice jobs number that comes up from the US, almost 3/4 is government related. So what are the new jobs in the US is you work for civil servant. I'm not saying here, but let's here you are working for either civil servant, you're working in the hospital, or you're working for social work, all government related, like almost 3/4 of it. So if you talk about real private sector, that is actually contracting quite sharply. So with that slowing, then we think the US economy will also be like slowing down. The US consumer is also moving sideways. Ignore the big spike and dump, because that one is the base effect. Because pandemic, it collapsed, and of course when it reopened, everything went up. But it's just moving sideways. So that's why growth, because US consumer, US economy 70% is consumer. So that's also moving sideways. The other thing we worry about is that the US is under saving. So this is the roughly how much they save. So it's really low, about 4%. And because there's so much wealth now, the economy, the property is doing, reasonably well, but at least the stock market is doing well, so they're not saving enough. So if there is a spiral downwards, it could be quite fast, because if the US consumer wants to normalize their savings, so that means spend less. When you save means you're not going to spend, then it could actually cascade, the growth can cascade quite fast if they normalize the savings. Well, it means that they don't space, they have to save back what they didn't save in the past, and then that means they're going to spend less. So that's the, and then corporates are also cautious. So this is one way we track corporate spending. This is spending on equipment and all that. So that's also coming down. So China, we think is also deflating. Sorry, I got no good news here, but so one of the reasons why China is deflating is now China is very dependent on fixed asset investments. So if you look at this chart here, is as much as investments can be roads, infrastructure, property accumulated. So there's the blue line. So the problem is the beige line, which is the private sector. I think it's so bad that they stopped releasing the data the last few months. But anyway, what's happened is that the private sector is not investing. So all the investing is still coming from the SOE. And that in investments is a huge part of the economy. And okay, this is a difficult chart to read because you get this big zigzag in 2019 because they open and close. But if you just remove that, if you read the wording there, what it means is that China's retail sales now is 2%. Like Singapore actually, so which is pretty bad because they used to grow at almost 10%. So you can say that China retail sales is down from the pandemic onwards, is down probably 80%. So it's a sign of the real weakness of the whole US, the real consumer, because the consumer was supposed to be the one that bails out China. I'll run through. Okay, then the other thing, of course, property we know. The problem with property is not that it's creating NPLs or creating problem loans, but property was almost 30% of GDP. And once that collapsed, how are you going to feel that hole? Like consumer not spending, only 2%. So your only way is to export. So this is a chart of homes sold. It can be space or can be units. So you can see it's record lows and almost 30 months of decline. So why property is important, just to remind everyone, is that it's like all of us know when you buy property, you support the cement, the upstream, you support the cement sector, bricks, whatever. And it's not just the property itself, you support government land sales. And you also support the downstream, electrical goods. Less property means less electrical goods, less TV, fridges, and what. So this is a big hole that's going to gap. So it's going to be very hard for China to fill this hole because property is really collapsing and it's still collapsing. I'm not sure who's the speaker for China, but anyway. Okay, so the other thing is that, okay, my colleague. Yeah, okay. So the other thing is, deflation. I want to run through this. It's pretty obvious. So what is hot now in China is the red line. So everybody is rushing into bonds now. Yeah, everyone says there's a bull market in bonds now because everyone is so bearish. And of course, the hope is that the government is raising 20 and 50-year bonds, almost 200 billion. So everybody thought, no, the government going to raise that money and put into the economy. But no, they're going to probably put it into defense and AI. Probably make AI so cheap like an EV car. So what it means is that there is not the money that's going to be raised. The worry is that it won't be injected into the economy. So as the title suggests, it's a lot of tough medicine. So I think they will not be coming in to do any big fiscal stimulus to the economy. So the downtrend that you see in China, we think is still going to persist. They will still do monetary, but it doesn't really matter, right? It's already so low, record lows in interest rates. So we are still, at least for me, we're still quite bearish on China. Of course, they are going to rely a lot on exports. But you know who you're going to export to? You know, Europe, the one your exports. Then who you're going to export your EV to? US not going to take it. EU not going to take it. I mean, you can sell to emerging countries, but they don't even have electricity in the house. You ask them to buy EV car, it's so expensive. Who's going to buy? So that's why even exports we think is also going to be very troublesome for China. You might see in the very near term some good numbers for China because right now everyone is stocking up in the US because with the threat of Trump or with the threat of trade war, of higher tariffs. When you speak to any port operator or exporter, there's activity going on because everyone is loading up the inventory because they worry if once he comes in, there'll be immediate tariffs across the board. So everyone is just stocking up. So exports might do well in the near term. And as you can see from this chart, the China exports peaked in 2018. Then once Trump came in, then it just collapsed. Of course, there was a big bump in COVID. That's because COVID, everybody bought everything. So even China benefited. But so we think that even if they want to use exports as the driver, it's going to be quite troublesome. The benefit is actually ASEAN, because actually in a way, this China plus one kind of saved the ASEAN manufacturing sector because of that, now everybody have to manufacture in ASEAN, whether they like it or not. Okay, okay, so I'll move on to just very quickly Europe and also okay, so and also Japan. So for Europe, what we think is happening is there's going to be a global synchronized kind of easing. So before I go to the US, so we think the ECB has already cut once, so the ECB is already going to cut another time. So this is basically the blue line is basically the interest rates in Europe. It used to be negative, so you can imagine that you put money in and they have to pay them, but not for individuals. But right now we think it's coming down, so this could of course benefit some of the REITs in Europe, and it will of course benefit assets there. We also see cuts also coming to the UK. So UK inflation used to be 11%, come down to 2%. They still don't want to cut. I'm not sure why. They say that inflation not on a sustainable path, but I'm not sure. You just look at this, it really dropped so much. But I mean, we think also UK is going to cut together with the US. So it will kind of be very supportive for income producing assets like your bonds or even your REITs and so forth. And of course, there's this thing called Japan cutting rates, but we don't think so. So if you look at this chart, the problem for Japan has been inflation. So so the funny thing is that if you speak to a Japanese REIT, they hardly raise any rent, even though occupancy is 99 because they're not used to it. Then when are you going to raise 110? So this basically shows what happened in Japan is that inflation went up. So everyone thought they're going to raise rates, but like any good poker player, they got bluffed. So they didn't raise, but what they did was the whole currency collapsed. So the currency collapse is pretty severe in Japan. It's as bad as the Thai crisis. If you do, it's almost like 40% drop in the Japanese yen. And we think that yen is still going to come down. We doubt that they're going to raise rates because there's just too much. If you raise rates, they are already paying 5% of their interest to revenue. Then if they raise it, probably 30-40% of all the tax they collect have to go into paying interest. That's not sustainable. Then you're also going to hurt the banks a lot. So that's why we think they were taught like playing poker. Then they say I'm going to raise rates, but we don't think it's going to happen. So we still think, especially when the yen just improved, just appreciated, that gives them more cover not to raise rates. So we still think that it's still the only thing they're going to do is, you notice that when the blue line went up, the red line immediately kind of dropped. So instead of raising rates, they just let the yen collapse. Okay, then I'll just move on to equities. So what we see equities in the near term. So for equities, I will focus more on the US since they're the biggest. So the worry for equities is of course the red line. So the red line is the PE for equities. So you notice that it's now trending about maybe 22, 23 times. I blocked out that part because that is very volatile because those are really during the pandemic times. So The only good thing why you don't call it a bubble yet is because of the blue line. So there's still earnings growth in the US. So if you look at the big tech, your Magnificent Seven or FANG or whatever, their earnings is almost 50% in the first quarter. If you include Nvidia, even if you exclude, it's still like 30% growth. So there is still support for this so-called extreme valuations because the blue line is still coming up. So even though valuations are at 20-year highs, if you look at the red line, there is still support. So it's not like going to the extremes like you see in 1999, 2001. But if you look on the longer term, so this is longer term. So what they like to do is you take all the earnings the last 10 years because a lot of volatility, right? So if you take the long-term PE, which is the red line, of course, the greatest bubble you had was in 1997. So we are not the greatest bubble yet, but almost the greatest bubble. So we're not there yet. So there is still room for it to climb. So there is still some valuation support for the S&P before you start shouting and say, oh, things are gone to the extreme, because the red line still hasn't really gone up to the high extremes. Obviously, it's still at very high levels. And the blue line is basically S&P. So even if you were to do a standard deviation, it's not that extreme. Even though people might say that the US is running ahead, there is valuation support because earnings actually has grown in line with it. So in the conclusion, it's just to say that the valuations that you see here is actually well supported by earnings. It's not just the 1999 bubble that you see on the left. Okay, this is a very technical thing, but we just run it through because in the end, you also want to know whether compared to bonds. So this is just to tell you, okay, but interest rates has run up so much. Is the stock market in the US overvalued? So they like to use this thing, equity risk premium. In a layman terms, what it means is that how much should I earn compared to bonds? So at the high, people were expecting 11%. But right now you're looking at 6%, which is the blue line. So I mean, this is more for if you want to go technical on it. So even that also, if you look at equities premium, that means how much return should I be getting? My expectations, at least, it is not that high. It's still 6. The average is 4. So again, on that note, when you compare to bonds, the US equities, it's not excessive. I mean, unless you get a big recession, which you can see from the beige columns. It's only when you get a big recession and everything that's collapse. Okay, then the other thing is that so the other thing, the other debate is if you're ETF, we always hear people want to buy value, which I think in the whole Singapore market is value. So of course I want to promote value, but when you look at this chart, it's kind of hard to promote value. But anyway, the red line is value stocks in the US. And the blue line is all the growth stocks, and because the yellow is just S&P. So you will notice that after the dot-com bust, the value stocks outperform because everyone lost so much money in growth, nobody want to go back in. Okay, so that's the only time. That's the time when value stocks tend to outperform because the red line, right, outperform the whole market. Then when recession time, everybody drop. So that's the other thing. If you want to hide out, so some might say, you should hide in value stocks, but there's nowhere to hide. Everything just drops. So I'm not sure hide into what. So the best way is not to get to equities. If you look at this chart, if you want to kind of summarize it, that's why we say there's no value in being value. So you buy it when you think it will return, not as the way to kind of hedge out your risk. Then of course since then you will notice the value and growth names tend to move in line in 2012-13. But then from pandemic onwards, you notice growth stocks this went berserk. I mean, that's totally outperformed value, and that's mainly because of the whole tech, and also because the US growth has been exceptionally strong. So that kind of helps the US growth. The beige line is just recession. Again, if you hit recession, you don't even come near equities. There's nothing to hedge out. Okay. Okay, sorry, let me just... Okay, so the other thing to note is that, of course, the expectations now is going to be a September rate cut. So this chart is a bit complicated, but we always show this chart because this chart means in December, where everyone was predicting, including me, obviously was wrong, but But then after that, everyone started to raise their expectations in June. Then now they're bringing down the expectations of interest rates. So you don't look at the December 25. That one is more the Fed's forecast. But up to December, you notice that people are bringing down their expectations of interest. So this is important for REITs. So if you had this blue line forecast, you lost a lot of money because the interest rates expectations went up. So right now, the market thinks that you're going to have 2 rate cuts. Actually, even in Europe, even in US. So we think it's going to be, of course, positive for bonds and even REITs. And there's a 90% probability of a September rate cut, which we think not lah. But anyway, that's where. So there's a Fed meeting coming up on Monday. So you must have to watch whether Powell actually gives a hint at September, and he might be cornered because market already expect 90%. So he might be cornered and say that most likely he would do. He may not do it in July on Monday, but he might hint that there will be a rate cut in September. Then you of course you get the usual rally. And this one just to show you that green line, just to show you even the Fed believes that there'll be rate cut. So interest rates is now, let's say 5%. So even the Fed thinks they're going to be rate cut by 2025, at least 3 rate cuts. So rate cuts is almost a done deal. I mean, just that, of course, the market has been caught off guard so many times, so nobody there to bet on it. But just a reminder, interest rate cut doesn't mean the equities will rally. So you will notice the blue line is the interest rate. So when you have a big rate, sometimes when you have a big rate cut, it's because there's a recession. Then of course, the equity market will collapse too. I mean, if you look at the rate line. So it doesn't mean you rate cut. But I think this time around, because there is no tail spinning, no downward spiral in the US economy, we think a rate cut will actually kind of inflate the market. But the thing to watch, if there is a recession coming on, then rate cut also doesn't really help the equity markets. So it's not always that rate cuts is a positive sign and you go rush out and buy everything. Okay, I will just move on to elections. This is a hot topic. So this chart is basically the betting chart. So the red one is, I don't look at the polls, because polls, no value, is who put the money, right? So this is where people bet. So people are betting about almost a 50+% odds that Trump will win. And then the blue line was Biden, now goes 0, of course. Now then you have Kamala, which is about 30+%. So if you're near term, it's important to monitor this, because there's still 3 more months to go for the US elections. 3 months is long. The last 1 month, you already had the debate, and then Biden's approval rating collapsed. You had the assassination attempt, Biden stepped down. Then you had Kamala coming out. That's 1 month. Imagine 3 months, you times 3. There's a lot of things could happen. So from here to now, a lot of things could happen. So that makes us worry that the market might go risk off. So that the equity market, especially US investors, might risk off, because there's this thing called a tax cut. Because if Trump is not there, then the Democrats might actually raise back the tax, or because there's this so-called tax cut that he did in 2017. It's going to end of 2025. So assuming Trump wins, I do not know. I mean, like buying numbers, I do not know, right? So, but 2025, if things are aligned, this is the bullish case for US equities. Before I go to the bearish case now, so the bullish case is that there'll be a permanent tax cut, because then when Trump there, he will of course extend. After all, the name of is called the Trump tax cut. Of course, he's going to extend his name under his name, right? So then with Trump there, one bullish case is that there'll be more resolution, because right now the current trajectory isn't going anywhere. There's still conflicts. That's why he might resolve it. Then of course the Fed will cut rates. So there's a strong bullish case. And the fourth one is now the second wave of AI. The applications for AI spread from NVIDIA. I don't think so, but anyway, that it will spread to everybody, rush out and buy the handphone because there's AI. Not me, but anyway, other people maybe. But so that is the bull case for the US next year, tax cut and all that. But the thing to also take note that to pay for this tax cut, Trump has to go on a trade war. So Trump wants to raise tariffs on everyone. Anyone who bring in goods, they're going to raise. But it also means that people are going to react, right? The EU is not going to let you, okay, you're so nice, you need to raise my tariffs 10%. Obviously, they're going to react and also raise their tariffs on the US imports. So you worry of this scenario. The initial reaction will be positive, but you just worry that the second derivative is that there will be trade war between US, Europe, between everyone. And then also do note that specific to the big tech, which is about 40% of the S&P, the EU has a plan to raise this global tax, which is 15%. They didn't do it yet because Trump coming, but if they do that, then all the big tech names are going to get hit because they used to don't pay tax. Right? Then now they're going to get hit by a global minimum of 15%. So if Trump starts kick this ball, then there's repercussions too. So do take note and not be too overly bullish. I'm waiting for what time the lucky draw. Okay. Okay, then the next one is bonds. So technically, we like bonds. Long-term bonds isn't so attractive. If you're a chartist, you can draw lines very straight. Then you'll notice that bonds have actually broken out, which is the blue. Okay, so the bonds is the red line. So it's broken up from this super bull 40-year where, I wish I was a fixed income bond manager in this super bull. You just come to office and you don't do anything. Just come to office and you just write the bull because bond prices just keep on running. Just make sure you come to office and you're okay. Yeah, but we worry that this bull, longer term, I think there's going to be upward trajectory in interest rates. I will explain why. But in the near term, technically, we think it's attractive. One of the things that worry us why bond yields won't drop back so low, and then all the REITs will rally like superstar, is because there is a lot of supply coming out in the US. So just to explain this chart, so this is the amount of bonds. So the Fed stimulated. So it's nice. I mean, it's nice to stimulate the economy. Everyone have a party, but somebody got to pay the bills, right? So how you pay the bills is that you have to issue bonds. So you notice that there's this big spike in bonds. So this is net issuance of debt to public. So this is the amount of debt that people from can be American citizens, Chinese. Chinese not buying anymore, or Russians. Obviously, Russians cannot buy. So all the American citizens have to go and buy all these US bonds or some friendly Europeans. But what we're just trying to show you is that pre-pandemic, on average, the net issuance every year was about 1.1 trillion. So this will jump to 2 trillion. That means there'll be new 1 trillion of bonds issued every year to fund the government because they're having a party, right? Somebody got to pay. So someone's got to pay the bill. 1 trillion, and it's not just 1 year. The problem is this is going to continue. So you need to find 1 trillion 1 year, 2 years. So this is going to pile up 3 trillion, 4 trillion. So who are these buyers? I have no idea. So that's why there's going to be a big spike. We worry that there's going to be a big spike in bonds, and that's why even if interest rates come down, it may not come down that much. And the other problem, one of the problems is that the US is on fiscal deficit. So it's an autopilot because in the US they have this thing called Social Security, where it's auto. That means if you are, I forgot the retirement age, but if you're above 60 something, you get like $2,000-3,000 because you contributed. It's auto until the final days. But so you're going to get, and as they age, so this is their own projection, and that's why this deficit is autopilot. So this amount of bonds issued is virtually a done deal. You cannot turn it unless you don't want to be president, or then you cannot bend that curve, or that orange line. And the amount of revenue you collect, it won't move much, especially Trump doesn't want to collect any more tax from corporates, or at least less. So that's why the amount of debt coming out is a worry, and that's going to cap interest rates. But near-term bonds look cheap. So we got this fancy fair value, but it's just an average. So if you look at bonds, okay, so that the red line is where the yields are. So if you want to do very simple calculation of how much a bond should be worth, it's very simple. It doesn't mean it's accurate, right? Just simple. So what it means that you should take your inflation. Then of course you need some yield above of your inflation, right? Because you can't if inflation 2%, you collect 2%, then what's the point? So you want some extra yield, then term premium, because if you're taking 10-year bonds, you want more because you're taking more risk. So as a result, very near term, it looks cheap because it's 2.6, but longer term, I think the fair value is about 4.5. These are for those people who specialize in bonds, otherwise you're going to kind of ignore this. Okay, but anyway, I'll just quickly run through for commodities. So for commodities, of course, gold was a winner. Industrial metals recovering, but again, we're also not very bullish on industrial metals. So so this is the ETFs for all the various types of commodities. The yellow one is gold. Then the second best performer is industrial metals. It can be aluminium, iron ore. That we're not very bullish because we think it's just being inflated because China needs to complete all these homes and can't be leaving them out there. So you still get this one last surge in demand, then we worry after that it will be weak. Then of course you got agri, which we think longer term is more attractive than the red one is the whole commodity complex. So and of course the black one is gold. Of course, of course you can buy oil, but always be wary of this negative roll yield. So basically what it means in very layman terms, so even though oil price might go up, you'll notice that if you buy into this ETN, you actually lose money. Of course, don't scold the issuer because it's meant to be like that. Because there's this rollover yield where let's say you buy oil at $80, then you want to roll up because it ends, let's say, by tomorrow, because these are all short-term things, right? So you will end tomorrow, then because there's a contango or oil is higher, you end up buying 90. So imagine you sell 80, then you buy 90, right? It's the opposite of making money, right? You sell low, then you buy high, but that's how it's structured. So it's very good for more tactical things. So that's why buying commodities through these instruments is a bit of can be an issue because of this rollover yield. So of course, gold, everyone's hot on gold. How to value gold, nobody knows, which is a good thing because it can be 5,000, 20,000. You also don't know, nobody knows how to value. So that's the good thing about it. Not like stocks you can value. Actually, but if you want to value gold in terms of just roughly as a percentage of world GDP, so gold price is the red line. So if you want to take a step and try to guess the value, so of course you got this gold-silver ratio that doesn't work now, but you'll notice that gold as a percentage of the whole economy is, I think it's 17 trillion now, the value of gold. It's already hitting quite extremes. So you're talking about the super bull that gold had in the 1970s. So again, not saying that gold, don't buy, don't have to complain or gold rally, but I'm just saying that it looks extreme because it's already 17 trillion, like how much more, like 30 trillion, the value of gold. So this gold above ground, sorry, just to let everyone know, it's not the gold in your jewelry and so forth. Of course, gold prices went up because China has been buying, but again, this is just a food for thought that if you want to do a valuation, it's very elevated. Of course, oil is the other thing everyone likes to play. Just talk about it since it's a talking point. Not that there's many instruments to buy, but we think oil near term is very well supplied because if you look at the blue line, that's the inventory, and it tends to correlate very well. So if inventory comes down, inventory goes up. Actually, it's the inverse. Goes up, then of course the price of oil will actually come down. It's a bit harder to comprehend because this thing is inverse. But in the medium term, it's very negative for oil because although Saudi Arabia cut, but the rest didn't cut. So US, so they actually sacrificed themselves. So nice of them. But you notice the numbers on the right that over the last 2 years, Saudi Arabia cut, they got spare capacity, but the rest didn't. US just rammed, and the fragile five, which is your not so friendly neighbors like Iran, Iraq, Libya, they all keep on ramping. So in the medium term, there's a lot of oil in the market. Also a lot of spare capacity because OPEC is actually holding back. So this is basically production of the US continuing to rise in the fragile five and Saudi Arabia, just for your reference. Because since you talk commodity, we have to talk about oil. But the one thing we like about oil is that if it comes down a lot, it's worth considering because there's a lot of event risks for oil. So you'll notice okay, it's not a copy from all the various media, but it's just something to note off is that oil can spike anytime because right now all the conflicts don't really affect, they don't really attack the oil facilities. So you notice that in 2019, there was an attack on Saudi. I forgot the name. Just slipped my mind the name, but there's this very big oil facility in Saudi Arabia. It's like probably 30% of the world's supply. So they didn't destroy it. Obviously they can, but if they did that, then the whole oil price would just spike up. Likewise in 2019, they just damaged. They could have sunk it. I mean, come on, they just damaged. So nice and just to damage it. So they could actually sink some oil tankers. So what I'm saying is that if oil actually comes down to a certain level, there's a lot of hidden premium in terms of like event risk behind oil. And likewise also, Ukraine can, if they want to, I mean, they can just damage a refinery and then oil price will just spike up too. So that's why we also thought that oil is another way to hedge out any risk, not just gold, because there are very specific geopolitical risks on oil. Then of course, the weirdest thing to do, the weirdest thing to do was when you, I'm just trying to read the article. The weirdest thing to do is when Ukraine, this one's not good for anything. This one is when you want to just buy aluminium cans, because what happened was that Ukraine went and destroyed Russia's nuclear radar system, which isn't good, because then the Russian got to take that binoculars and see if there's any nuclear weapon. So this is not good for us because it doesn't alert them, and it could actually trigger something unwarranted. So this is another thing. That's why, and of course, there's going to be a huge hurricane season coming up in the US. So that is also another why we think all could be one way to play, to hedge out apart from gold. Okay, the other one we like is agriculture, mainly because I use palm oil. Because this is what we are more familiar with. But any formulation palm oil, you notice that after years of growing planted acreage, they can't grow anymore. So actually, supply is quite capped. And Malaysia, Indonesia are the two largest palm oil producers. So that has kept, and we think, consumption always rises, but then supply is getting tight because of land and so forth. Okay, I will run this through quickly. So for us, we like ASEAN, not only because we are here, but also because valuations are at decade lows. So if you look from this chart, we like to go something contrarian. And behind the scenes, ASEAN has done well. If you look at just foreign reserves, but of course, mindful that a lot of it comes from Singapore. So actually, the balance sheet, in a way, you could say, of ASEAN has actually improved significantly. Likewise, again, investments coming into ASEAN, especially China Plus One, that we really think kind of saved the whole ASEAN manufacturing ecosystem. Otherwise, everything would have just gone to China. So thank you, Trump. Next one will be, the problem for going into ASEAN is that the currencies. So if you look at this chart here, so the blue line is the Thai baht, the Asian financial crisis, everybody forgot. But anyway, you'll notice that the way the yen has dropped is as bad as the Thai baht. But of course, nobody talks about it. Because can't go there, although holiday destination, but not as good as during the Thai baht crisis. But so you notice that the Thai baht has Japanese yen has collapsed a lot, and almost similar to Thai baht. And because of that, when the Asian currencies are down, no one buys Asian stocks. Because everyone still looks at currencies, and that's why it's going to be hard for ASEAN to climb, because you're a technical competitor. China is your competitor, and with the yen dropping like that, of course, Chinese renminbi is also going to drop. So that's why it's going to be hard until we get some inflection point on Asian currencies. Of course, ASEAN equities, Asian equities is still going to drop. No thanks to the Japanese yen, although good for holiday, of course. So what we need is really the Chinese to consume. They are buying AI. I'm not sure why, but no, they're spending all the money on AI. So the problem is that if China were to consume like a normal country, you actually can inject 3 trillion into the world economy, which is a lot. The whole world is probably 100 trillion. So you could add. So this is the thing that we are hoping for, but it's not going to happen. I mean, you can just look up the sky and just hope, but it's not going to happen. So this chart basically shows the consumption as a percentage of GDP. So China consumers under-consume. They're only like 40%. US, of course, the extreme. But even if you just push it up to Indonesia level, you can actually stimulate global economy. Until that happens, so of course, I'm not trying to bring this up just for trivial, but just something to monitor. The big catalyst for whole Asia is if China really, the consumer consumes, not raise 200 billion and spend on AI again. Sorry, I keep talking about this. Yeah. So any final word for those? So this is more investment talk now. So why invest? So if you look at this, the red line here is wages. Mine is lower, of course, but this is the growth of wages. So this is the wage that you get from EPF, the average wage growth. So on average, your wage growth 3%. Again, mine is lower. But the average wage growth is 3%. But if you look at the various asset classes, So what it means is that investing can actually outgrow the kind of wage they grow. So it's not just working hard, which doesn't apply to me too. But anyway, but it's not just that. So of course, the first one, if you stop picking guru, you buy DBS, you would have made, I don't know, 11%. But no, assuming you're not so clever, okay. Then you just buy MSCI. I don't need to be so clever. Just buy everything. You also outperform compared to putting your money just relying on wages, because investing can grow. Of course, even STI, everybody hates it, but because we pay a lot of dividends, and there's this thing called compounding, and of course property too. But property, are you leveraging, or are you force saving? The good thing about property is that you force save, right? Because you got no choice. After the banks call you, so you have to put one side. Otherwise, you would have take the money and party. I'm not saying you're, I'm talking about other people, but the thing is also, are you getting a gain from leverage? So, but this is the Singapore index. So just something mindful for you to think about. But again, investing can really outpace the kind of wage growth that you get. Okay, I'm going on my last slide. So in conclusion, actually nobody asked me my view about ETFs, but I'll just tell you. So nobody wants to know any, but anyways, I'll just tell you. So for me, ETFs is a cheaper way. I mean, I worked in funds before. I worked as a fund manager before. It is definitely much cheaper. It is a very tough competitor for a lot of mutual funds, and it's almost inevitable because this is they outperform most fund managers, and they're cheaper. It's also a very disciplined approach. But again, it is always remember that this is the ultimate risk-on instrument. So what I would say that is that, let's say you take S&P, NVIDIA is roughly about 6% of the S&P index. But if most fund managers won't go 6%, and most they hit 5%, and then compliance will be shouting at them already. So that's why technically, in a way, by default, they are almost shorting the NVIDIA because they can't buy. So it's not that the fund managers are bad, but just that there are some technicalities that limit the ability to go all in and a lot of stocks. And of course, for ETFs, it's the ultimate risk on, because no cash, zero, I mean, like hardly maybe 1%. So there's no cash drag. But funds, sometimes they might need some cash for redemptions and so forth. So that's why, just bear in mind, ETFs is the ultimate risk on. In the short term, we like bonds and energy. In the longer term, this one I can say, even wrong number, because nobody's going to come back in the long term, right? It can be 50 years, 20 years. But anyway, in the longer term, believe me, this is what we like. You can come back after 10 years if it's wrong. And one thing to just watch out for is, just as a disclaimer, since this is a general investment talk, is sometimes you need to hedge. Hedge means sometimes you have to take some money out of the table. Because always remember, not to sound like someone nagging you, but when you have a big loss, you get this so-called asymmetric negative compounding. I know it's a big word here. What it means is that, let's say you lose 50%, compounding is nice, every day goes 7, 6%. But if you get a big drawdown of 50%, so imagine you need to double your money. It's pretty obvious, but again, you need to just double your money. So it's asymmetric. That means it's not symmetric. That means not like 50% down, let's go 50%, you're back on spot. So always do remember to hedge some of your risks, because if the thing looks elevated. Okay, anyway, that's for, conclusion is for those who slept the whole time, but anyway, that's the conclusion. Okay, any thank you. I'm not sure you, yeah, okay, thanks. You're not sure there are any questions.
Right, thank you, Paul. All right, we have finished the second speaker, and I think what Paul has shared, I hope, has been useful for you to get some perspective onto the macros for ETF. And I think what he has shared is also quite heavy, so there's a lot of topics involved, and some of you might feel a bit tired, right, absorbing all the information. So something exciting to start the next segment, right? So I think you see this bowl I'm hugging in front of me, so you also know what this means. So if you will, please take out your bingo card. All right. Do note that you can, you must keep on to your bingo card till the end, because you will not, if you lose it, you will lose a chance of winning the grand lucky draw towards the end of the session. Okay, so for the first lucky draw, we have the Polaroid Go Gen 2, the camera that come out the camera photo directly for those that do not know. All right. And it's worth around $228. All right. And for that price, we will have our next speaker, Mr. Bruce Zhang from CSOP. All right, he's the head of fixed income, and he'll be drawing the prize for you. Right, so lucky draw time. Right, so everyone get ready, your bingo card. I try to shuffle first. Fair bit, Oh, shoot. One fly out. Okay, so he'll be drawing one. So the winner, I will staff that we're going around with a piece of paper for you to note to redeem your prize later on. All right. Okay. The first winner, I'll give you all the first hint, is a 3-digit number. The first digit, not zero, of course, I won't be so funny. 3-digit number, first digit 1. Okay. Just in case you all don't know, we have 224 participants as of this lucky draw, and we have 228 already inside the venue. And thanks everyone for helping us make this a full house event. All right, the first number is 1, and then next number is 2 squared, 4. All right, 148. Is there 148 in this room today? All right, thank you. Congratulations for being the first winner. My colleague will pass you a slip of paper. Right, it's just to note that you are the first winner. So it's 148. My colleague, please write on the paper also. 148 is the first winner. And I hope, sorry, not throwing. I forgot to take it aside. Okay, I'll keep it aside. Right, so note that after you win, you do not have a chance to win later, but you at least get a guaranteed prize now. Okay, so thank you. That is the first lucky draw. We have another lucky draw after Bruce share. All right, I'll pass the time to Mr. Bruce Young. All right, thank you. On one.
Okay, congratulations again to the lucky man. Now it's time to check whether the luck is coming back to the S-Reits, because we have been talking about this topic for 2.5 years. Now, hopefully we can see some rebound for the S-Reits, because we have been discussing this topic 3 months ago through the same Phillip session. So if you look at the past 2 years developments, the S-Reits still seeing a lot of headwinds, such as the high inflation, high cost, monetary tightening, or even the tight spread. But even with that environment, the S-Reits, particularly for the 6 S-Reits with Singapore exposures, they can still manage to achieve a decent rental reversions, and also the relatively good occupancy due to the limited supply. This is because even we are talking about the SGX listed S-Reits, they have some exposures beyond Singapore, but majority of their exposures are still within Singapore. And from a sector perspective, they are not only have the exposures to those cyclical names, such as the retail, office, or hotel REITs. They also have the exposure to the new economies, such as the industrial logistics, as well as the data center REITs. So they can play some offensive themes, but they can also have some defensive features over time. So how about the Singapore's economy? We have to say, similar to our comments 3 months ago, the recovery is still bumpy, the road is still bumpy, but even until the second quarter of this year, the manufacturing PMI are still above the 50 watershed. So the economy are still in an expansion mode, and that's very important. But more important part is about the inflation. So although the speed is slow, they are gradually declining from their previous peak. So this is quietly beneficial to S-Reits. Then SGD again, it's a bit against this intuition, because when you invest in the SGD asset, you definitely prefer a strong Sing dollar versus other currencies. But it is not necessarily true to S-Reits, because particularly for those S-Reits with the international exposures, if the SGD is stronger, it means their overseas revenue, all else equal, will be lower. So from this perspective, this has impacted for those S-Reits with global exposures. But these headwinds can turn into tailwinds, particularly given that if the Fed finally start to cut and MAS also follow the similar move, then the Sing dollar can gradually be weaker, particularly for against those emerging market currencies. And if that happens, perhaps in September, then we can see the further rebound of the S-Reits, particularly for those international S-Reits with the international exposures. And once again, about the sector breakdown, we have mentioned these 3 months ago. The supply and demand dynamics, they're still relatively okay for industrial REITs, but except for the business parks. And these imbalanced supply demand already drag a bit on the occupancy part. But in terms of the rental reversions, this can be totally a different story. This is because most of the rental contracts, they were signed during the COVID period, which typically had a discount. So now it's time to renew those contracts. So even the renew price is lower than the current spot price. They are still much higher than the previous contract price. So that's why we can continue to see a positive rental reversion for the industrial REITs. And the first quarter's data is already echoed this, because the occupancy falling a bit because of these supplies a bit more than the demand, but the rental can continue to rise on a quarterly basis, particularly for the warehouse segments. So for the rest of this year, or for the whole year, we can still expect the industrial rent to increase by a lower single-digit rate for the whole year. And data center, I think I don't need to mention that much, because the utilization rate is almost 100%, and demand is very strong because of this AI boom. Because the AI boom, the first beneficiaries are mainly these upstream firms, and the requirement or the request for the calculation power did benefit the data center REITs. And also, it's also important to note that Singapore, they used to restrict their supply of the data centers and only start to release some quotas or capacities in recent 1 or 2 years. So this gradually increase of the supply is just about right to meet the current strong demand. So data center are still quite okay. And moving to the next slide, for the office, we have to say this year's supply pressure is still there, particularly also including the so-called central areas, because we still have the central Bolivar Tower, not far from here, and also have some redevelopment of the Capel towers, including the 333 North Bridge Road. But if you look at the next 2 years, the supply will be much lower. So at the time, the supply demand dynamics will further support the office rents. And also, we also see some pressures from the sectors such as technology sectors and also the Chinese firms. Their demand start to decline. But as long as there are some winners in different cycles, such as the wealth management firms, or legal firms, financial firms, so there is always a demand, particularly for the city center, the CBD, grade A offices. So the demand for flight to quality, flight to green, and the relocation cost concerns, they still benefit the S-REIT retention ratios, particularly for those grade A offices. And this is particularly true for S-REITs as compared to those US, UK, Australian offices. Even these days, some of the employers, they are less keen on this work from home arrangement. For those countries, there are still a high ratio for the work from home the initiatives. So from this perspective, S-REITs or S-REIT office REITs, they're still in a relatively good position for now. For retail, it's very interesting because at the beginning of the year, when we observe these retail sales trends, we see the retail sales price rebounded, reflecting the inflation change. But the shopper traffic or the foot, they are not quite strong, which means the sales volume is not that strong. But if you look at recent months, even the retail sales, the shopper traffic, that start to recover, and thanks to those the returning tourists, and that's why the downtown malls are seeing an even stronger performance than the suburban malls are in recent years. And we believe this continuing tourism recovery, also boosted by this strong pipeline of the MICE events and also the concerts almost every month, and these will continue to support the downtown retail sectors. And these are also echoed by the first quarter's results because the top line growth are still quite good. And on a forward-looking basis, we can still see a positive middle to single the rental reversions for this year. And also thanks to this high occupancy rate for the malls, which is over 90%. And in addition to that, we also see the malls are still doing something new, the AEIs. For example, they can leverage the unlocked gross floor areas and also conduct some tenant mixing efforts to further bring in a stronger and trending brands. These can bring in a more organic growth. Even the M&A growth is not quite strong at the current stage. And that's also, again, to explain why the CBD leasing is still quite strong because of these back to office crowds together with the tourism recovery. And very similar to these industrial rates, the retail rental reversion, they also have three-year leases, which were signed 3 years ago. Now they are renewing their contracts, so their rents can definitely be higher or inflating versus the previous years. Tourism, quite clear. I don't want to repeat the numbers. So the first round of the reopening in Singapore happened in 2 years ago, but at the time, it's mainly from the global investors, also including the regional travelers. But this round, particularly for this quarter, we did see the Chinese tourists coming back. Because of the visa-free treatment, not only by Singapore, but also by Malaysia and Thailand, more and more Chinese tourists, they can come here through the so-called free travel or even through this group travel. If you look, you have time to go to the most popular attractions in Singapore, you can see, you can hear more and more native Mandarin speakers like myself. So sometimes they come back, like let's say 3-4 people, and sometimes they can also take a group travel, like the summer camp vacation travel. So that's very important to support the hotel rates this year. So even at the beginning of this year, the RevPAR already start to slow a bit because of the high base effect and the ease of these so-called the revenge spending, revenge travel. Now we are still quite confident about the whole hotel sectors, and this is already echoed by the recent room rates of RevPAR growth. And occupancy growth are still lag a bit, but it is not surprising. But we should bear in mind that the supply, maybe back to the previous slide, the supply, because of the COVID impact, the supply is very, very limited in the upcoming years. And demand can still be driven by the Chinese tourists. So the hotel rates should still have a good position in the next couple of months at least. And this one, we already mentioned this 3 months ago, when the S-Reits, they conduct their outlook for the rental reversion for this year, they are still quite constructive. Even they can be moderate from last year. The total, the absolute number of the growth can still be at least middle to low single digit growth for this year. And this has been echoed by the first quarter's results. We did see a quite constructive positive rental reversions. And for the yield are still quite attractive, still more than 6% like our product. But the valuation, even despite the recent rally in early July, the PB is still within the 0.8 to 0.9 range. So that's a very attractive level for S-Reits. And for the spread, I have to say it's still a bit tight at the current stage, but it's not because of the yield is low. It's simply because of the risk-free rate. The Singapore, let's say the Singapore 10-year yield is high. But once the Fed start to cut and once the MS start to follow, then the risk-free rate will finally go down. Then it's a very good time to capture this widening spread and reinvest into the S-Reit sector. And also the operating cost used to be a concern for the daily operations of the S-Reit managers, but now the wage growth a bit easing, not great to us, but great to the S-Reits performance. And also the labor market is light tightening. But more importantly, the average the inflation, including the electricity price, they start to go down. And even without this, the S-Reits, particularly for those leading S-Reits, they have a pricing power to pass these costs through and to the end users. So from this perspective, see, the cost is no longer a concern for the S-Reits, at least for most large and mid S-Reits. And again, we are talking about the interest rate impact every time. It's definitely one of the biggest drag in the past for S-Reits. That's also explained over the past 2 years. Even we have a decent yield, the S-Reit price are still going down. But now these drag can be the key driver because if we don't, without this concern, then the borrowing cost will be lower, and also the discount rate will be more favorable to the S-Reits. And just like we saw in early July, the S-Reits finally rebound 5 to 6% for the whole month because now markets are pricing in the first rate cut from the Fed will happen in September. And thanks to this high for longer environment for the past 2 years, the borrowing cost has already expanded by more than 1% for S-Reits. But for this year, we think the turning point will finally coming because the S-Reits now are expected that their borrowing cost are expected to rise to another 0 to 50 bips, and then they will peak. Then the implication here is that even the Fed is not going to cut or just cut once, the funding cost it will anyway peak. So the downside, the biggest downside for S-Rate will be gone soon. And to echo this point, the first quarter for this year, the S-Rate's borrowing cost has already increased by up to 60 bips. So from this perspective, the increase of their funding cost will be finally slow down or even increase next year. So investors should or can position in S-Rates ahead of a change in these funding costs. And this is a chart we recently plot. If we try to learn from the historical experience, investors should invest in S-Rates ahead of the rate cut. And taking the last round of the rate cut cycle in 2019, then actually, if you can invest in the S-Rates 6 months ago, or even 9 months ago ahead of the rate cut, and your forward 12 months return will be the highest, like even more than 20%. And now that the market expects the first rate cut in September, it's quite a good time to reinvest into this sector. Or even if the Fed can postpone its rate cut to December, now is still a good time to invest in the S-Rate sector. And despite these high interest rate in the past few years, the total gearing for the S-Rates are still quite okay. And another good news that MSCI most recently also raised their leverage limit for S-Rates from 45% to 50%. So this can leave more room for the current S-Rates to develop their existing projects. And even with this previous gearing limit or the ICR limit, the most S-Rates still have some revaluation buffers before reaching these previous 45% gearing. But now that the gearing is 50%, I think for those names with a small buffer, now their buffer definitely become larger. And in addition to the leverage limits, the ICR ratio also loosened because in the past they request 2.5 interest rate coverage ratio, but now it's lower to 1.5 multiple. So I don't think this means that there will be more bad quality S-Rates on SGX. It's just they just released a bit because in the past the requirement is too high. Now it's just be more in line with the global standard. So investors should have no concerns about this relaxation. And again, the asset spread, the yield spread for the office, retail, industrial, that's still quite okay, but office continues to see some negative spread, so still under some pressure for now. But the good part is that a lot of headwinds are pretty much gone for now. Inflation started cooling down, costs start to decline. Even the monetary tightening is behind us. Borrowing cost maybe still have a few 10, 20 bips to go for the rest of the year, but it's almost peaking at the current stage. So all the headwinds now is turning to tailwinds for the S-Rates, particularly for the rest months of this year. And valuation, I mentioned a little bit. Again, why we are saying that the spread is fair? This is simply because the dark blue line is too high for now. Because if you look at the yield at the bottom, the yield is quite attractive. So even we think the spread for now is tight, the current spread is still fair, relatively fair. And if you plot this spread and yield scatter plot chart, they are still quite in line with the historical average. But more importantly, every time when the S-Reits fall back to this range, we see a very strong support for PB, 0.8, 0.85. For example, July, we already see a rebound which used to push the PB back to over 0.9, but still below 1. But now after recent corrections, it's back to the range near to 0.85. So investor can reconsider investing in S-Reits ahead of the September rate cut, if any. And this way is very important, not only because this is our products, also linked to your bingo card. So highlight those key information. So our CSOP IH S-Reits Leaders Index ETF, the tickers are SRT and SRU. SRT is the $1 counter, which most investors typically use. And if you investors have some US dollar at hand, you can use the SRU. And our AUM is $70 million. And since inception, we managed to maintain a relatively stable AUM because although the price is going down, but the dividend, we tend to pay a dividend annualized more than 6% over time over the past nearly 3 years. And for the investor to access these products, the starting size is just 1 unit, which is less than 10 Sing dollars. So it's very easy to access. And more importantly, we pay the dividend semi-annually. And our most recent payment or the ex-dividend date just passed the most recent dividend date, which is July 19th. But investors should have no worries because the next round of the gain will not from the dividend because we already paid. The next round of the gains will come from the capital gains once the Fed start to cut. So that's very important. And these are EIP products. We have a TER 0.6% capped. That's very important, which means regardless of the size, our fees will be capped at 0.6%. But the good part is that for the S-Reit, we also track the SGX, the SGX index, the SGX S-Reit Leaders Index, which means we are not only include the largest S-Reits, but also include the most liquid S-Reits. I think this is very important at the current market cycle because the large cap bias, which means we can provide some defensive features when the market during the market downturn. But once the market is going to start to rebound, their beta, their liquidity could actually the best suit to capture the potential rebound for now. So that's why we think it's a good time to reaccess this sector. And our sector breakdown is actually a result of this market cap and liquidity screening. So we don't start from the sector allocations, but rather through the market cap and liquidity screening, it's a result of our screening. And in addition to the single exposure, we also have a lot of APAC and global exposure. So for every single investors in Singapore, out of Singapore, as long as you use the SGX listed S-Reits ETF, you can still access the international projects or growth opportunities, but your withholding tax will anyway be 0. So I think that's why we can use S-Reits to access the APAC and global opportunities. And since inception, we outperform the benchmark by more than 60 bips, which means we outperform the whole annualized TER. So even after deducting the fees, we can still slightly better than our benchmark. I think that's very important to investors. And from absolute return perspective, it looks ugly, but now it's quite really the right time because now the S-Reit level is not far from their historical maximum drawdown, but is far from their previous peak. And in July, they already, because this performance as of end of June, but in July, they already rebound by 5 or 6%, and then corrected a little bit in recent week. But now they still have a lot of room to in terms of the further rebound, particularly during the period between now and the first rate cut in September. So now it's a good time. So the more decline you see on a daily basis, the more confident I can recommend you to reinvest into SRT. And the last slide is just our top 10 holdings. We don't mind to disclosing this because we are quite transparent. Those our top 30 our full holdings is actually available to investors on a daily basis on our website or Bloomberg if you use Bloomberg. Why we are comfortable to disclose this? Because investor can definitely directly invest in any of the underlying S-Reits as long as you have a high conviction. But investors should also be aware of the concentration risk and the drawdown risk, just investing in a few names of these underlying REITs. And comparatively, the ETF vehicle can definitely provide a diversified universe for investors to capture decent yield, like more than 6%, but can still control the volatility at around 15%. So that's very important. And also, even investors can create their own basket, let's say using a 4,000 Sing dollar, then it's still not a very small amount. And for an ETF vehicle, it's just less than 10 Sing dollar. And more importantly, from a trading perspective, if you go to the SGX to trade those REITs, of course, some are still quite liquid, which means you can still get a very tight beta spread. But through our dedicated institutional trading desk, we can achieve a very, very low trading cost through our trading desk. And we can transit this saving to the ETF pricing and benefit all the S-REIT ETF investors. And that's why we think now is a good time to go back to S-REIT, particularly for ETF vehicle. And that's all for my sharing today. Yeah, thanks.
Thank you, Bruce, for the sharing on Yeah. So thank you, Bruce, for the sharing on S-REITs. I hope that helps to give you some flavor of what is to expect for S-REITs itself and performance to be maybe some rebound there, hopefully. Okay, so for the next one, you'll be the final speaker before your lunch time. All right, so before lunch, you hit your final speaker. And just a reminder, I was informed to let you know, please do not rub your lucky number. Sometimes you like rub number, the lucky, right? You rub already, the number will disappear. Then you no more lucky because cannot claim. Okay, so please do not rub the lucky number. And if you find that your number is fading, do let our colleagues know outside before it really fades finish. Because if it fades finish, then cannot claim already. Okay, just to take note on that. Okay, so just aside, the next, sorry, did I press too fast? My lucky draw, yes, correct. So the next one will be, the next lucky draw will be by Mr. U-Jin, who is the Deputy Head of the Asia ETF Business Development for Nikko AM. All right, so we'll invite him on stage to do the lucky pick. All right, and hope all the best for all of you all. This lucky draw prize number 2 is a Fitbit Lux Fitness Tracker worth $168. And he has already chosen the number. All right, this time round, wow, this number, I can say quite lucky, because it's just added not long. 3 digits starting from 2. All right, just now I said we have 224, right? Just now 224. As of what I was informed when we came in, it was 242. And this number is actually between the 2 numbers. So it's a 236. And based on this number, I will expect that it's not in this room, right? Because for your information, this room is already full house, and we have opened up the academy room on the other side. 236, my colleagues, another room, please assist to check whether it's in the spillover room. All right, so in case you somehow find it too compact here, outside is also, the next academy room is also full. We are also screening this session at the SGX IPO, the arena area, the big stage area. Right, so if you go toilet, come back, you can still see on the screen. Okay. No, okay, cannot find. Okay, I give the person 5 seconds more. 236. Look at your lucky draw. Maybe you're also inside here for some reason. 236. Last call 5 times. If I don't see it, we will take the next number. Okay, he found the person. Sorry, So, but don't worry. You will never till now means you have chance for the grand lucky draw. Right now, always think of the better, right? Think of the better. So, without further ado, let me pass the time now to U-Jin, who will share more about the fixed income investing. Just now was S-Reits, now fixed income investing amidst the volatility. All right. Let's give a welcome to U-Jin. Sorry.
Thank you. Thank you for the kind introduction. Thank you everyone for coming to SGX, filling up the auditorium. Right, it's very nice to see that it's a full house today, especially on a Saturday. And I know I'm standing in between yourselves and lunch, so I'll try to keep this interesting. I'll try to keep this educational. And I hope that at the end of my short presentation, you would, if you need a refresher on fixed income as an asset class, why bonds in a wrapper like an ETF could be useful for you in your investing journey and in your portfolio, then I would be very happy. Okay. So I'm the deputy head of the Asia ETF business development team here in Asia. One of the questions on bingo asks, how many fixed income ETFs or bond ETFs does Nikko AM have listed on the SGX? The answer is 3. Right, so we have got a Singapore government bond index fund. We have got a investment grade corporate bond ETF. The last one that is, the lesser known brother of these two is a China bond ETF. But today I only have time to speak about the 2 Sing dollar denominated bond ETFs. Why is this interesting? Why did I single out the Sing dollars? Well, it's really because the Sing dollar has shown, resilience and strength, and also the reason why Singaporeans like to travel, right? Really because of the currency. But aside from, the strong currency that these two funds are denominated in, why do people like fixed income as an asset class? Okay, I've listed 3 reasons here. There are probably more, but I think these are the 3 reasons that I want to share with you today. Income generation. So bonds, if you invest in a single bond, you do know that you will always have income, coupon payments regularly. It's either usually semi-annually, twice a year, sometimes once a year. But coupon payments are a big feature of bonds. And at the end of the bond maturity, whether it's 2 years, 5 years, 10 years, you do get your principal investment back. Portfolio protection. If, theoretically speaking, if let's say that there's volatility in the markets and there's a drawdown in your investments, if you lose 50% of your investments, that means that just to get back to where you started at 50% down, it means over the next period, whether it's 1 year, 5 years, depending on your time horizon, that investment has to climb back up twice, right? Double. So portfolio protection is, in my opinion, almost as important as growth potential, right? Because if you look, volatility may not be something that all investors can stomach, right? So fixed income, generally speaking, they are counter-cyclical to the equity markets. Correlation traditionally between fixed income asset classes and equity is, there's very little correlation. So that gives you inherent portfolio protection. It acts as a dampener of sorts against, drawdowns and risks. Lastly, diversification. It's related to the first point, right? Diversification away from equities. If your entire portfolio is equity-based, that's all right, that's okay, but diversification is the free lunch, so to speak, right, in investing. Right, so if you have got equities, you can diversify it into what my friend Bruce talked about, REITs, markets, for various reasons, and then you can diversify it further by considering bond ETFs or bonds as an asset class. Now, this is the Singapore dollar fixed income market. So I share this quite often. Just to give you a bit of history, back in 2018, right, when the MES and Nikko AM, we launched the Sing dollar investment grade index as well as the ETF. And this was really the plan was to allow investors, retail investors in Singapore, to get access in relatively bite-sized amounts to fixed income as an asset class. because in the wholesale market, if you wanted to buy a single bond, the minimum investment size, the first clip would be around usually about 200,000 to 250,000, which may not be accessible to the man on the street in Singapore, right? I don't have $250,000 in Sing, actually in most currencies, right, lying around, right? But now with an ETF, with the help of MAS and NICOM together, right, we've got an ETF. Today, you can get access to the fixed income market for as little as $1, right, which is roughly the price of where the bond ETFs are trading today. Okay, so that's without your trading costs. But even if you've got $2, right, you can get exposure to the fixed income market. That's how easy it is. You do not need $250, right? Okay, so now this is just a bit of history. Why NICOM and why we are in this game. This is just a matrix between risk and return. So there's no free lunch. If you want more returns, if you expect more returns, you're taking on more risk, which is what this graph is showing. All the way on the top right-hand corner, that's the high yield bond space. I'm not going to really touch on it, but I think the poster boy for, well, not great reasons would be maybe the China property market. Bonds issued by China property developers. You've heard of names like Country Garden, Evergrande. They were close to default. Bonds that were trading at par value, so about $100. Currently, they're trading at about $30 or 30 cents to the dollar, right? But that's the kind of risk and return matrix that these bonds occupy, because they were giving you, well, relatively good yields, right? Maybe 13, 14%. But then you take on a lot of risk. One day, if that issuer defaults or it's close to default, an investment that was $1 would have dropped to 25 to 30 cents almost overnight, right? So we are not in that spectrum. So we are in the really safe, maybe a bit boring part of the spectrum, which is where the Singapore government bonds lie. You do know that Singapore government, we still maintain a AAA rated rating, which means this is as safe as any investment is likely to get in the bond universe, right? I don't think, no other country issuer in Asia has got AAA rating. Only the Singapore government bonds, right? And they have maintained this for the last 25 years. So over the great global financial crisis, over the Asian financial crisis, they have been able to maintain this rating. So it's very safe. However, you do get, right, the requisite returns, which is a little bit lower. Now moving up a little bit, we've got the investment grade corporate bond space. I've got a chart. I just want to show this to you. This is where this is credit rating, which is important when you analyze bonds, right? At which part of this spectrum, in terms of risk, are you investing in? Near the top would be AAA, so that's where the Singapore government bonds lie. Investment grade, so the other section of the market that I was talking about, Singapore investment grade corporate bonds, that's somewhere in the middle, AAA. But even if you have, a portfolio of bonds that are in the BBB space, right, that's in the middle, in the blue space, that's still considered investment grade. Why investment grade? It just means that, relatively speaking, they are able to stomach more volatility. They are good for their money, so to speak. If you lend this issuer money, at the end of the period, whether it's 5 years, 10 years, you should be able to get your money back. And they are able to repay your coupon payments every semi-annually, every 6 months or a year. It gets a bit hairy right at the bottom. So if if your bond investments are all rated CCC, CC, D means default, right? They cannot pay your coupon payments when it's due, or they're not able to give you back your principal at maturity. And this is where, as I said, things get quite hairy, and then there are liquidation or bankruptcy proceedings around that, right? But we're going to focus on the investment grade spectrum today. I promise that I'll try to give you a bit more information about the fixed income asset class. Do people, if you understand yields, then there's the concept of credit spreads, which which just means that for more risks that you're taking, more credit risks that you're taking, you need to be rewarded with more returns. So Singapore government bonds are usually seen in the Singapore dollar bond market as the risk-free rate, right? And that's denoted in the light blue line at the bottom. So you can see roughly Singapore government 5-year bonds, right? They have been giving you, anything from 2%, close to maybe 4% recently in 2022, and it's still hovering around 3.5 to 3.7% as of May or June this year, right? So that's considered the risk-free rate, right? If you lend money to the Singapore government, after 5 years, you get your 2-3% yield, and at the end of the day, you get back your principal in full, and it's almost risk-free, right? If they don't pay you back your principal, we as Singaporeans, we've got much bigger problems than our investments, right? But then now if you lend to DBS, so if you invest in DBS bond, or you invest in any other bond that is in the investment grade corporate bond ETF, for example, it could be DBS, OCBC, it could be Temasek, for example. Are they as creditworthy as the Singapore government? Well, the answer is no, right? And how much less creditworthy are they, right? In this chart, it shows you that they are 100 basis points less creditworthy. That means for the same amount of borrowing, right, they need to pay you a bit more in terms of your returns, which is about 100 basis points. And that's the credit spread. So between the risk-free rate and credit, right, investment grade credit in Singapore, you're getting 100 basis points more per annum, right, per year for taking on that credit risk. So this is what this chart is saying, talking about. Same data, just in a different manner, right? I just take the yields on the investment grade space minus the risk-free rate. This is the spread, right? It's not kaya, butter, toast spread, right? This is credit spread. Yeah, you can see that it spikes, right? Why does it spike? So the first spike here on the left-hand side, can you see that it spiked all the way up to 200? That means the risk that investors are demanding from the investment grade issuers doubled from, okay, I can take on credit risk for 100 basis points. Suddenly in March 2020, you're demanding a credit spread of 200 basis points. What happened then? Yeah, COVID, right? I still see some audience members wearing masks, right? Really since March 2020. And why? Because volatility in the market, right? And what happens when, right, credit spreads go all the way up. And then similarly, in October 2022-23, so 2022-23, you can see that there's been a spike and now it's steadily coming down. So this is not COVID, but this is another phenomenon, which is inflation. Central banks trying to fight inflation, they raise borrowing costs. So what is this trend when credit spreads go all the way up, when yields go all the way up, what happens to price? That's really the next bit of education that I'm trying to share here. Right, this is the inverse relationship between price and yield when it comes to bonds. So when credit spreads shoot all the way up, what happened to bonds? You as a bond investor, if you held some bonds, you probably wouldn't have been too happy because interest rates go all the way up, prices swing all the way down. How sensitive is that swing? Is measured by this measure called duration in years. So just a rule of thumb, because of this inverse relationship, if interest rates go up by 1% and duration, I'll just use an example. Let's say duration is 5. Interest rates go up by 1%, price of your investment with duration of 5 will swing down by 5%. Okay? Right? So you can think about it. If the duration measure is very long, 10 years, any small movements in interest rates would have a much bigger swing in price. So it was painful, right? As a fixed income investor, when inflation was high, central banks were trying to rein in inflation by raising interest rates. Right? But it's not all doom and gloom. The good news is that do we think we are at the end of this rate hike cycle? Generally, yes. Right? Or that's our hope. Okay, we've been waiting for since the start of this year. The Fed has pushed back expectations, but I think now the signs are quite close, right? That maybe by the end of the year, we'll see at least one or two drop in rate cuts. Okay, so that's the potential capital appreciation that you as a bond investor might have. But even then, sorry, just moving back to this. If you're a new investor, if you've not had any exposure to bonds, and you happen to look at these charts, right, sometime in, let's say, January 2023, where the spreads were almost 200 basis points, would that have been a good time to invest in bonds? Generally, yes, right? Because you would have locked in these yields. So prices would have been depressed, the yields would have been high, and we've not seen this kind of yields for a very long time. I've got another chart to show to share later, right? But this is a concept of when we say lock-in yields. Sometimes you read articles written by us, other asset managers, your advisors may say, this is a good time to lock in yield, right? It's really because of this almost once in a generation kind of movement in interest rates. This is just a mathematical example of the inverse relationship between price and bonds. Price and yield of bonds. I won't spend too much time on it, right? Because now I want to go to, I've talked about fixed income as an asset class, it's really about bonds, but why bond ETFs? So in ETF circles, we always say, don't put all your eggs in one basket. Yeah, have some vegetables. When you're having lunch later, do have a balanced meal. So same concept applies for investments, right? So this picture shows two things. One, diversify away from equity. If it's, you're wholly concentrated in equity, diversify, you can look at REITs, as an asset class, you can look at fixed income. But even within fixed income, do you just buy one bond? Right? The reason why, I think, once again, going back to history, why MAS and Nicoem decided to launch investment grade corporate bond ETF, right, is because we want to break it down for investors, retail investors, right? Instead of putting $250,000 in just one bond, one asset, one single bond, one single issue, one single maturity, right? Get an exposure to a whole spectrum of issuers. Okay. Now this is a lot of words, right? The market outlook. I'll just summarize what we at Nicoem with our portfolio managers think the market outlook would be like for the rest of the year. So there might be some volatility in the near term, right? As we close out the year, I don't believe it's almost August. So I think there's always going to be debates, right? Rate cuts, rate hike, inflation data comes out, unemployment data comes out, and we should expect some volatility, right? But nevertheless, we still believe that directionally global bond yields are coming down, and that's what we're looking forward to by the end of the year. Corporate bond yields have declined from the peak. I'll show a chart later, but they still remain attractive on a historical basis. It's still healthily high, even as far back as 20 years. So once again, it's almost a once in a generation kind of opportunity to, what you shared just now, lock in some yields. The credit spreads have been resilient, right? Remember, it's about 100 to about 200. Now it's stabilized to about 100 again, right? And think about these credit spreads as a buffer against any short-term volatility in the interest rates. Okay, so I think it's still a good time to get some exposure to fixed income. If you don't have exposure there, diversify. It's always diversifying your investments is always a good thing. And so do consider fixed income, adding fixed income to your portfolio. Okay, there are some risks, right? So if inflation continues to be very sticky, or any kind of geopolitical risks, especially with some big elections coming in the US in November, those are just some risks you should be considering. This is just a short summary of the kinds of bonds you can get exposure to in the two ETFs that I talked about. So on the left-hand side, this is the ABF, so AAA rated. Singapore government issues about 80%. SGS, Singapore government bonds, take up about 80% of the ETF. If you buy into the ETF, 80% of the portfolio is in AAA rated, very safe Singapore government bonds. Not to say that the other two, HDB and LT, is not safe, lah. Right? There's a reason why they're called quasi-sovereign bonds. Quasi-sovereign just means like sovereign bonds. Are they sovereign bonds? Are they Singapore government? Not quite, but still considered very safe. Then on the other end, investment grade. So what justifies the 100 basis points or almost 200 basis points additional spread that you get investing in bonds issued by banks, statutory boards, insurance companies, REITs, etc., etc. So still quite heavily weighted in banks, bonds issued by banks. So you've got DBS, OCBC, UOB, the usual suspects, but also foreign banks. Foreign banks issuing in Sing dollars, you can get exposure to them as well. Some banks might be, let's say Macquarie, ANZ, they do issue in Sing dollars once in a while. Now, duration, I think it's in your one of the questions in the bingo game. So once again, sensitivity to interest rates. The ABF is about 7.7 years as a measure. Investment grade corporate bond 5.6 years. So if interest rates, once again, why is this important? If interest rates start to come down, longer duration means that the swing upward would be more pronounced, right? So in terms of quantum, it's about 7.6 times more pronounced, right? Versus something with a duration of 1. Okay. So yeah, we mentioned that on a historical basis, the yields are quite attractive. And I hope this chart on the top shows why we think it's attractive from a historical basis. So it stretched the data back all the way to 2013. So roughly 10, 11 years of history. Right, so this basket of this index, which comprises of a basket of Singapore government bonds mainly, is currently yielding at about 3.13%. And if we looking at the data 10 years ago, it has never been so high. Right, it peaked at about 3.5, 3.7%. Right, but still, if you've not you were not lucky enough to get locking your use at 3.5%, at 3.13% is still pretty attractive, considering the AAA rated ratings of these bonds. I'm going to try to use the laser pointer here. No laser. But what I do want to share here is that 2021, 2022, when central banks were going on this rate hike cycle, you can see the bonds did not do well. You can see in 2022, it was down 6.4%. Not great for bond investors, not great for me as a business development manager talking about bonds, right? But the thing is that once the rate cycle started to peak, once the expectations that rates would start to come down, what happened the next year? You could see a rebound, sort of 4.4%, right? You may ask, why did they do well in 2020? Right, because of COVID. So there was investment grade, Singapore government bonds as an asset class safe haven. That's why it did well, right? When it does the best whenever there's a lot of uncertainty in the market. Equity markets were hammered, right? Bond markets, safe haven asset classes like this did very well. Similar story for the investment grade sector. So 3.7, you can see, well, back in 2013, 2014, it hit about 4. So it's a similar story, but not as pronounced as the ABF. And you can see that the peak happened sometime in 2022, going to 2023, and then it steadily started to come down. So yields have started to come down. Still not too late. The window, I don't think is entirely closed yet because, right, 3.7. But if you had locked in your yields at 4.5%, almost 5%, and yields have started to come down, as this chart shows, what happens to your investment? The returns have done very well. I would say it's quite amazing here. When I did this chart, right, at the end of 2023, 8.6% returns over 1 year, just because of rate cut expectations, right? So it did exactly what this asset class was supposed to do, exactly what we expected it to do. I was just pleasantly surprised that it shows so clearly, right? Will it continue to come down? I think generally, yes, we are expecting further rate cuts, right? Debt continues to strengthen, right? And if rate cuts do continue to go, right, I think 2024, the returns could be quite attractive by the end of the year. Okay. And what's also good about the investment grade corporate bond sector is that, once again, remember there's some buffer, the credit spreads. So even if there is some short-term volatility, even if there are some fears that the rate cuts may not be coming so early, right? Yields go up a little bit. At least you still have about 100 basis points worth of buffer that you get from the credit spreads. And then you're not taking on that much risk as well. You're still safely within, right? Remember, the credit spread spectrum is safely within the investment grade part of the spectrum. Yeah. So this is just a summary, right? Just 3 points. Generally speaking, interest rates have significantly adjusted from the low levels, relatively attractive from a historical basis. So I've given you 10 years of data. ABF and investment grade corporate bonds still relatively attractive. Corporate bonds, remember, because of the spread, right, gives you some kind of buffer against short-term to medium-term volatility when it comes to yield, right, as the markets debate the actual timing of the rate cuts. Okay, and then lastly, this is, if, let's say, the war in Ukraine, just is touch wood, let's say, or there's another, some other conflict that just explodes across the world, which asset class did better, right, during the COVID crisis, right? That's the Singapore government bond asset class. That part of the spectrum did better, right? So if you expect some volatility, then go for the safe haven assets, which is represented by the ABF ETF. But if you want steady yields, some credit spreads, right, to help you buffer against short-term volatility, then maybe the investment grade corporate bond ETF is slightly better for you. But if you're very bullish that interest rates are going to come down and you want to get a bigger swing upwards, which one should you go for? You should go for the one with the greater duration, which is the ABF. Okay, so that's how I hope that with this information, the backdrop and the sharing that I had over the last 20 minutes now, right? If you do see volatility in the market, that's not something to be afraid of. Now you're better educated, you're better able to make your investment decisions, whether you want to add more duration, you want to pull back on duration, you want to get out of fixed income entirely, or you want to balance your portfolio as necessary, right? So it's not something that there's an easy decision to make, but I think with more education, with more familiarity with fixed income concepts that I shared today, credit risk, credit ratings, duration, this will help you in the decision-making process and help you get a more robust portfolio, okay, for whatever investment needs you might have, whether it's paying for your children's school fees in the future, for a retirement, or maybe even a holiday at the end of the year. Okay, thank you so much. Yeah, thank you so much for your time. Hope it was helpful.
Yes. Good afternoon, everyone, and congratulations to the gentleman who number 75 for winning the lucky draw prize. So good afternoon, everyone. Thank you for joining us after your lunch break, and hope you have had interesting insights throughout the event today. I'm Shin Xiang from Lion Global Investors. You can call me LGI's ETF guide. So I'm here today to share with all of you about 2 key building blocks you can use to diversify your portfolio. The first ETF I'll be sharing will be the Singapore Low Carbon ETF, which is this ETF. Key fact, it has outperformed the STI since its inception on listing date. So along the years, in the past 2 to 3 years, we have outperformed the STI. Another ETF which I will share about later will be the world's first APAC Financials ETF, which is our APAC Financials Dividend Plus ETF. It gives a quarterly distribution, annually around 5% per annum. So these are the 2 ETFs, take note. And before I start and give a deep dive into the ETFs, let me share a bit about LGI. We are one of Southeast Asia's leading asset managers, part of OCBC Group. And as you see here, we are further growing within the ETF business. We have around 70 billion Sing dollars of assets for our clients. And we started our ETF journey back in 2017 when we launched our first ETF, which is the Lion-Phillip S-Reits ETF. Today is the largest REIT ETF on SGX already. And since then, between 2020 to 2022, we listed 3 ETFs within 18 months. And this year alone, we have already listed 2 ETFs, our Japan Active ETF and also our APAC Financials ETF. And if you apply the cutoff as of the end of 2023, 3 out of our 4 ETFs actually achieved top returns within their respective segments of REIT ETFs, China equities ETFs, and also Singapore equities ETFs, which is our Singapore low carbon ETF. So I mean, it's pretty amazing in terms of our growth journey. Today, we are already one of SGX top 4 ETF issuers. And our ETFs are also within the top 10 ETFs held by retail investors like all of you and myself included. If we zoom further into the segment of SRS investors, our ETFs also rank within the top 10. And by trading turnover, we also rank within the top 10. And all these are because LGI, being part of OCBC Group, we are Singapore incorporated. Singapore is our home ground, so we are committed to delivering quality investment solutions for investors, for our clients within Singapore. And that's why we decided to brainstorm back then about creating a more green and also 21st century version of the STI. So the STI was built back in the 1960s, around when Singapore gained independence. I see some gray hairs here, so maybe it's some of the age, is near some of the ages which some of you were born in. So STI was constructed back in the 1960s. And because of this, it doesn't include constituents that are listed beyond Singapore. So because of this, that's why we built a greener and also 21st century version of the STI to include more constituents, not just those listed in Singapore, but also at the same time take note about lower carbon footprint for Singapore companies. Before I start and zoom into the specifics, I will start with a first prize giveaway question. So Kathleen here, my colleague, will be giving out a wireless mousepad charger for one of you who answer the question correctly. Very easy question. Who is this gentleman here? Yeah, this gentleman. The full name? Yep. So yes, PM Lawrence Wong. He mentioned in the 2022 International Energy Week that Singapore's net zero by 2050 target is actually a stretch target. But because we wanted to do our part to tackle the global issue of climate change, and this is where we started our journey in terms of decarbonization and also to achieve net zero by 2050. So all these, a lot of us, we know Singapore as a little red dot. But this also is the vision that will transform Singapore into a little green dot. And there's a reason, because climate change affects everyone. There are 2 types of risks that climate change poses to our portfolio. First type is physical risk, easier to understand because it has caused natural disasters, triggered loss of lives, loss of wealth. The latest example will be Typhoon Gaimi, which has affected China, Taiwan, and also Philippines. The second type is harder to understand. It's about transition risk, mainly brought about by policymakers. So for example, in budget 2022, Singapore actually introduced an increase in carbon taxes. So for those companies that are unable or unwilling to reduce their carbon footprint, they may face higher funding costs or a potentially lower share price. So all these are important issues and risks we need to be aware when investing and building our portfolios. And that's why we built the Lion-OCBC Securities Singapore Low Carbon ETF to help investors decarbonize your portfolio and at the same time include constituents, not just listed in Singapore, but also those listed in Hong Kong and also in the US. And throughout these years, especially for constituents that are listed in US, they have seen actually significant outperformance. For example, C Limited has grown just this year alone, rallied by 80%. So all these are actually constituents that help to boost the performance of the Singapore Low Carbon ETF. 3 key features. about the ETF. It tracks the top 50 largest Singapore companies by free float market cap. There's a 7% securities weightage cap. This part is important because it provides sector diversification and also securities diversification. And third thing is about semi-annual distribution in June and December. These three key features. And here alone, we also look at the index, which tracks the top 50 largest Singapore companies by free float market cap that are representative of Singapore's real and financial economy. So this key thing will be about the reduction in the weighted average carbon intensity. Sounds complex, but it basically means it tries to minimize the amount of carbon emissions per $1 million of revenue. So we pick companies that emit the lower amount of carbon emissions per $1 million of revenue. So because of this one, you'll notice is that compared to the STI or MSCI Singapore, our index chooses companies that emit the lowest amount of carbon per $1 million of revenue compared to the STI or also MSCI Singapore, which are significantly lower. And in terms of performance, we have outperformed MSCI Singapore and also the STI since our listing on the 28th April of 2022. This boils down to three key diversification this ETF offers. Because it's July, I've come up with the term GSS, geographical, sector, securities, GSS. Just remember Great Singapore Sale, geographical, sector, securities. In terms of sector, you will see a more even distribution. So you see the STI and MSCI Singapore, they're actually more weighted towards financials, around 50%. But because we apply a more even distribution and also weightage of different sectors, you'll notice that actually there's a lot more higher weightage to technology, which has actually seen a huge rally in 2023 and 2024, attributing to greater performance, while at the same time help reduce the potential volatility because it's spread out across different sectors, as you see here. In terms of geographical diversification, what you notice is that it consists of constituents listed in both Singapore, US, and also Hong Kong. So there's greater geographical diversification. As you see here, the three local banks are inside. There's also Singtel inside, which has also performed well during this period. But there's also C Limited and Flex Limited, and also Grab Limited. So you see here, C Limited rallied 81% as of this year within the past 6 months. Flex Limited around 37% during this period. So the inclusion of US listed constituents actually helped to boost the ETF's performance during this period. So all these brings about the diversification in terms of GSS, geographical, securities, and sector. And before I move on to the next slide, here's my next prize giveaway question. I mentioned it at least twice already. What's GSS? Yeah. So congrats for remembering GSS. So yes, these three are the important letters to remember because it means that you do not have to sacrifice returns when you decarbonize your portfolio. And it is possible to do good for your portfolio and the planet. And here are the ETF's top 20 constituents. You'll see here, 3 local banks are inside. There's also C Limited, Flex Limited, Grab Limited. And here will be my next prize giveaway question. I'll be deep diving into 2 key constituents of this ETF. The first one starts with S. It's the owner of Shopee, Moneybank, Garena. So I haven't asked lah. So maybe this time I take this side because okay, maybe the orange gentleman. The first, I'm talking about the first. Yes, C. So I'm glad you managed to see this. The second would be a company that starts with F. It's the world's 3rd largest electronics design manufacturer by revenue. So maybe this time I take this side. The white gentleman there with the cap. Wow, you are really flexing very well to be able to notice the white gentleman with the black cap. So yes, I'll be talking about C Limited and Flex Limited. So for C Limited, after a series of cost-cutting measures in 2023, started 2024 with excellent earnings, kicking off with a strong quarter, business growth for all three of its businesses, Shopee, Garena, and SeaMoney. And you will notice that Shopee actually achieved the strongest growth and record high in terms of quarterly orders, achieving a record high also in terms of gross merchandise value. So it's an interesting company. And if you notice for the next one, for SeaMoney's perspective, there's also grew revenue and adjusted EBITDA by significant amount of percentages. So all these have helped it rally around 81% since the start of the year. And because of this, if you look at the analyst target share price, there's still around 15% in terms of upside potential that has been identified. So this is a high-profile growth company from Singapore. Next company will be Flex Limited. Similarly, started a strong quarter in Q1. And also in the latest quarter, it achieved record high in terms of operating margin. So because of this, you will notice that since the start of the year, it has grown around 37%, just by applying the cutoff at start of the year. If you apply since April 2022, this growth is actually much higher. So this is what we have noticed. And this is actually a lower profile value company. But an interesting thing about this ETF is that it is actually a high profile growth company element, but also a lower profile value company element, where you get a diversified blend of value stocks and growth stocks bundled together to help you do good for your portfolio and also the planet. So to summarize, the Lion-OCBC Securities Singapore Low Carbon ETF provides you diversified exposure to 50 Singapore companies committed to a lower carbon footprint. And with around $1 and remembering this SGX ticker, you get to enjoy this exposure to 50 Singapore companies that are committed to a lower carbon footprint. Right now, before I talk about my next ETF, I have a price giveaway question. Easy question, I just dropped a huge hint. Maybe this time, what's the $6 SGX ticker? Okay, this gentleman with white collar. Yes. So thank you for remembering ESG. Easy three-letter, but it captures the essence of this ETF. It is an ESG fund. So right now, I'll talk about our next ETF, which is the APAC Financials ETF. Okay, so this is our next ETF. Key things to remember, two key features. World's first APAC Financials ETF, 5% per annum quarterly distribution for the first 2 years. So when we think about financials, a lot of us actually think about banks. But actually financials are an ecosystem, not just about banks, but about companies that provide services and products that focus on the growth, storage, and transaction of money and assets. And it has prospered throughout the centuries because it is an essential capital provider for economies worldwide. It's an ecosystem, not just about banks, but it's also about investment management, for example, like LGI, about insurance, and also brokerages like Securities and exchanges, which is, for example, like SGX, where all of us sit in right now, because it helps to smoothen the flow of capital to power economies worldwide. And when we talk about financials, actually a lot of us would just think about the global landscape, global financials, which includes the US banks. But APAC is an interesting region because it's a high growth region, a deep dive. Globally, financial services is already amongst the world's most profitable sectors. But within APAC, actually 55% of the adults are underbanked. And this represents the largest underbanked region across the world. And a lot of the APAC banks can actually simply grow further by just tapping and serving the underbanked within the developing APAC countries. And the high savings rates within APAC is also much higher than the world's average savings rates. And also within APAC, ASEAN and Singapore, which is our home ground, also contributes to the higher savings rates within APAC. Key figure, amongst the world's top 30 banks globally by assets and market cap, 14 of them, which is around half, are actually APAC banks. And this is important because APAC's high saving rate gives and deepens the deposit pool for a lot of banks and financial institutions and helps to power economies and be able to improve economic resilience across these APAC economies. And if you look at the ETF, it's APAC Financials, Dividend plus ETF. So what is in the plus? 3 key catalysts. First one is about cushion profitability. We have already seen in the past 2 years, banks globally posting record high profits and also in terms of return on equity. So much so that sector ROE is around 13%. And this is against a backdrop of around 9% average ROE in the past 14 years. And during this period, actually, is because of the high interest margins that have been contributed by rate hikes. But in this environment, we are expecting more and more likelihood of potential rate cuts. And in this kind of scenario, it's important to tap on well-capitalized banks. I'll touch on why well-capitalized banks are important because they are more likely to maintain profitability. I'll talk about it further later. And the second is about the Asian tilt, key thing. The next decade, more APAC banks are expected to join the top global 100 banks because wealth contributor actually will come from APAC. So all these will catalyze the growth of APAC financials. The third is about the pivot towards capital-light models. Key figure, in the past 6 years, 16% of capital contributed to 33% of profits among APAC's financials. And because of this, even DBS in their annual report mentioned that digital customers are more profitable. And going digital, going capital light is expected to increase profitability. So this is important. And with all this happening, these catalysts are long-term catalysts. They take time to be priced in. Because of this, the valuations are still relatively attractive if you compare it with the STI or even the S-Reits leaders index. So in terms of PE, we are around 11. In terms of price to book ratio, we are still at around 1 as of 30 June. Because all these are long-term catalysts, they take time to be priced in. And some of you might ask, hey, the US rate cuts are coming. So how will this impact APAC financials? Key thing is an ecosystem with businesses that react differently to rate cuts. And second thing is that the expectations of rate cuts could actually drive more investment activity because when you reduce the risk-free rate, more investment activity will follow because you have to take more risk to generate returns. And with this, actually, some other arms, for example, like wealth management within DBS, actually posted record high profits. For example, it reached around 1 billion Sing dollars in the latest quarter in Q1. And another thing is also the banks are also sophisticated enough to protect their net interest margins through longer term fixed rate assets, for example, like giving longer term loans. And the next thing that is interesting about the ETF is that it provides geographical diversification. Because across the world, you will see that a lot of us are waiting for US rate cuts or anticipating US rate cuts. But there are certain countries that are actually looking to increase interest rates. One example is actually Japan, which has seen a lot of inflation recently with currency depreciation. And because of this, they are targeting to increase interest rates, especially in the upcoming BOJ meeting that's happening on 30 or 31 July, to increase interest rates. So what happened in the past few years in net interest margins for the Singapore banks or even the US banks could happen for the Japanese banks. So right here, you see that as Sumitomo Mitsui Financial Group, which is one of Japan's largest mega banks, said that if interest rates just increase by 0.1%, they expect to gain 40 billion in additional profits. So right now, they already hold 58 trillion with the BOJ at 0.1% interest. So it's roughly 58 billion yen in net profit. They increase 0.1% more, and they will get 40 billion yen of more net profits just by putting the money, like what you do by putting into a savings account. So by this virtue, the net interest margins, net interest income will further increase. And all these are potentially good and beneficial for the Japanese financials. So to summarize, financial sector is an ecosystem diversified across different geographies, and all these have helped it prosper throughout the centuries. And that's why we launched the APAC Financials Dividend Plus ETF to help investors like you and me take advantage of the different interest rate movements that are about to happen. So it's the world's first APAC Financials ETF, tracks the top 30 largest and most tradable APAC financials. 3 key steps involved. First is about index criteria, sector, there's banking, insurance, investment services, and also a special sector, which is called specialty finance and services, because this is where the digital banks are grouped in. And this is the part that will make the index more future-proof, because if the digital banks grow large enough in terms of market cap and also start paying dividends, they could be included into the index. Second part is about index selection and weighting. Key thing is about 7% securities weightage cap and also a 20% country weightage cap to ensure geographical diversification. And in the end, what you get is 30 constituents weighted by free float market cap. And in terms of key features, remember 3 things, because this ETF helps you focus on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution. Growth, potential capital appreciation within the APAC financial sector. And since our listing date, which is 13 May, the ETF has actually grown in terms of performance. It has outperformed the STI and also the IHS Leaders Index since its 13 May listing. And here are the different breakdowns. You will see that in terms of geographical breakdown, it's rather evenly split across 6 countries: Japan, South Korea, Hong Kong, Singapore, Australia, and Malaysia. And these are the different portfolio constituents you see. You see the 3 local banks are within top few. And right now, I will pause here because I have another 2 prize giveaway questions. The first constituent I will later talk about will be one that starts with S. I think similar thing, like the previous one, I also start with C Limited. This one also, there's also an S inside. It's one of Japan's mega banks. I'll take a question from here, the answer from here. Yes, SMFG, Sumitomo Mitsui Financial Group. Thank you for remembering. Next one starts with K, is one of Korea's largest financial groups. I'll take it from here. So me to this gentleman. Yes, KB. Yes. So it's a KB Financial Group, which is part of Kookmin Bank. And these are 2 interesting constituents because they are one of the few, besides the 3 local Singapore banks inside. You'll notice that since 13 May, because since 13 May, the listing of the ETF, the return actually has been around 15%. But you look at the Singapore banks, DBS, OCBC, UOB, they've been rather flat, around 1+%. So this is an interesting outperformer, and also Mizuho Financial Group, because these are being expected to benefit from the interest rate hikes that are about to happen within the Bank of Japan's interest rate decisions. So in terms of the first constituent, I'll talk about Sumitomo Mitsui Financial Group. Interesting company, reached record high profits. CEO already came to say that for every 0.1% increase in interest rates, they expect to gain 40 billion yen in terms of profits. Since January 2023, the share price actually grown steadily. Within May, since listing, it has grown around 15%. And it has also achieved record high in terms of net business profit and also bottom line profit. I mentioned earlier, SMFG already have 58 trillion yen within the Bank of Japan's balance sheet. And just by increasing 0.1%, this 58 billion plus the 40 billion will add up to around 100 billion yen in terms of interest income alone. So this is an interesting constituent that will stand to benefit from the upcoming BOJ rate hikes. Next company I'll talk about is KB Financial, achieved record high in gross operating profit. It also acquired Prudential Financial's Korean insurance arm back then for around $2 billion, effective January 2023. And since then, share price actually grew significantly by more than 80% within this period, and there's still around 15% in terms of upside potential identified by analysts. And it's an interesting company because in its Q1 earnings, it already announced to pay around 300 billion won in quarterly dividends. And in its latest board resolution, which just happened a few days ago, there's also announced a cumulative 720 billion won in terms of share buyback to be able to help return capital to investors. So when it's about returning capital to investors, it's not just about dividends, but also about share buybacks or cancellations to help improve the returns to investors. So these are two interesting constituents. And to summarize, the Lion-OCBC Securities APAC Financials Dividend Plus ETF provides diversified exposure to 30 largest and most tradable APAC financials. Key thing to remember, 5% per annum quarterly distribution. And before I wrap up for this ETF, I have a simple question. This time I'll take answer from this side. What is the Sing dollar SGX ticker for this ETF? Yes, YLD, because 5% sounds like a good yield, which I hope you remember after this session. And we have covered two ETFs today. The first one is about our Singapore low carbon ETF, key ticker to remember, ESG. Top 5 constituents includes the 3 local banks, but also other constituents which are listed in the US, like C Limited, Flex Limited, that will contribute and potentially boost performance as like what they have done in the past few years. Next ETF will be the APAC Financials Dividend Plus ETF. Same thing, if you notice, the top 5 constituents actually also has the 3 local Singapore banks inside. But there's also the Japanese financials and Korea financials that could stand to benefit from their respective interest rate movements and also the regimes that are happening. So remember, APAC Financials Dividend Plus ETF, YLD, and use it to earn stable dividends of 5% per annum in quarterly distributions. I'll pass over the time to Huanzi, who will share about the next speaker. Thank you.
Thank you. Okay, so we will have our next speaker. All right, so we'll thank Shin Xiang for sharing about the Lion Global offerings. All right, so for the next speaker, we will have, all right, Mr. Tan Teck Ling, who is the Deputy Chief Investment Officer of PhillipCapital Management. All right, so he'll share more about what whether it's time to invest in the China market. I think this is corresponding to the first speaker, Paul, who mentioned about the China market might not be in a good shape. But let's hear from Mr. Tan Teck Ling on his view of the China market. Thank you.
Okay. Hi, good afternoon. Good turnout. Hi. Yes, I think I just introduced myself. I'm the Deputy CIO of PhillipCapital Management, which is another local fund management firm. So you may be familiar with some of our products. So today I'm going to be talking, I will be starting with just a brief outlook of China currently. Before I will also talk about a way to capitalize on the China equities markets if you think that you want to position into it currently, right? No prizes to give away for my end, right? But I will be conducting a lucky draw after that if there's any consolation, okay? Right, this is how I'm going to be talking about today. Right, give overview of China first. And for China, I will start by talking about some of the concerns that people have, because I guess what the press publishes about China now seems to be the risks aspects of China. Namely, I think you have the property sector, everybody knows, especially the private developers in China. right? Evergrande and so on. You have the slowing economy, right? Everybody hears about that, right? Deflation. So instead of inflation, large part of the world over, we are seeing some deflation. Not so much on the consumer products, but more on the production goods segment. And thirdly, of course, everybody hears about the geopolitical tensions with the West. So these are some of the key concerns. Well, when concerns and risks are widely published, what happens? You will get weakness in the market, cheaper valuations, people recognize the risks. So does that mean that you shouldn't invest? I think there is a brand of contrarian investing where people actually look for such bargains. So it is worth considering. But before that, I will talk a bit about some of China's key segments. So when you talk about economic growth, typically you talk about a few segments. Fixed asset investment, that means construction, building of new industrial goods and so on, right? Then you also have consumption. And then finally, you have manufacturing, right? Manufacturing and services. So I will go through some of these in each of these in turn. So give you a flavor of where we are or where China is now today. So here I just start with fixed asset investment. Over the years that you see here, right? So this is 2018, 2019, 2020, 21, 22, 23, okay? So this is a time series on the horizontal scale. And the lines here shows the different components that make up total fixed asset investment that I'm talking about here. You can see that over the last 5 years, the one that indicates real estate investment, which is the brown line, year-on-year growth has actually come down a lot, right? It used to be this level positive, and then the last few years negative, right? This brown line here. So year-on-year growth is negative, as would be expected for real estate in China. But if you look at overall, which is the blue line, right? The blue line is the average of all the various sub-sector components. Actually, it has been more resilient. It is still in positive territory, right? It is still around here, which is quite close to the pre-COVID time in terms of year-on-year growth for fixed asset investment. Why? Because some of these other segments of fixed asset investments actually help to cushion the weakness in real estate's growth. And in particular is infrastructure. You can see in the dark brown line here, right? That is actually still growing pretty robustly, right? So you can see that, of course, in fixed asset for infrastructure, typically is by the local governments or the central government projects like, energy, infrastructure, public sector infrastructure, highways, rails, all that, right? So all that contributes to growth in the sector. So that has actually continued along. So to the extent that actually fixed asset investment is actually pretty still well cushioned despite the property sector weakness. Consumption, right? Well, here you could, I guess consumption is one of the weaker segments in the China market today. That is if you classify 5% year-on-year growth in retail sales as weak, right? That is where China's retail sales is now today. It's weak because the trend growth, say before COVID, the long-term trend was double-digit % year-on-year, right? So today, the retail sales would be something in single digit, like 5% year-on-year thereabouts, which is this top graph is showing here, right? Below the long-term trend, right? But still positive, right? The weakness, of course, is because the confidence is relatively low among the population. A lot of their wealth, of course, is in real estate, right? So naturally, I think that also drags on the consumption sentiment, right? But certain segments are still doing well, for example, right? So if you see on the right-hand side, That is the travel volume during the Spring Festival. That's the Chinese New Year, right? You can see that actually it is higher than even pre-COVID, right? So that's something that you take note is a mixed picture for the consumption side of things, right? In fact, domestic travel is doing pretty well now, right? And for certain sectors such as household consumption goods, because of government policies, that is also doing well because the government is encouraging them to change their old domestic household goods for new household goods, right? Third key segment is manufacturing. Well, manufacturing is actually a bright spot in the current Chinese economy, right? If you look at the China exports, that is shown on the export volume here, right? The latest one on this one, export volume year on year, you can see that it has been rebounding quite strongly year on year. And in fact, it is currently at a long-term trend year on year growth, right? So that despite what you are hearing, actually China's manufacturing sector is one of the bright spots currently, right? And it wouldn't be surprising in a sense because they actually have a critical mass of production capacity in various industries. We talk about the high end such as electronics, but also the low end such as textiles and household goods and so on, right? So it is not doom and gloom, right? Of course, there are the real estate sector would take some time to digest the excess inventory, right? So that is the current state of consumption and fixed asset investment as well as manufacturing. A mixed picture, right? No doubt. But to give you a picture of the overall exposure for China's trade of its goods, the exports. So you can see that actually currently, right, as of 2023, as in comparison to 2017, its exports to US is about maybe 15% of its total, right? So it's actually the exports to the various regions as shown in the blue bars. It is a pretty balanced picture. If there is some trade tariffs, as for example, Donald Trump has threatened if he comes to power, of course, I think there will be some impact because US is one of the largest export destinations. But I think it's also possible for China to engage in various strategies. They can produce outside of China. They can look at other export destinations as they are already positioning to do so now, right? And this currently for the US is 15%. Of course, EU is also another one that has been talking about tariffs and so on China goods. But I guess China has more levers on the EU, right? Because China is a big importer, for example, of the EU's luxury goods, of the EU's manufacturing equipment, right? So there are some levers to push on this respect. One thing to note is the central governments and the central banks increasingly active stance on boosting growth. In the past few years, people have been talking about the slowdown, about the real estate problems, but I think the central government has been rather inactive or unmoved, right? But I think in recent months, at least 2024 so far, you can see a range of policies that they have undertaken to boost the Chinese economy, right? That ranges from monetary policy, such as cutting interest rates. That also covers fiscal policy, that means government spending, right? They actually they put forth an expansionary budget. That means the expenditure by the government will be in excess of their revenue, right? They have some property sector support. So that is a multi-100 billion yuan support that they are putting forth to encourage the local governments to buy up the excess property sector inventory. Then I think some people will be interested in what the third plenum that was held in July, that people were hoping for some big stimulus from the Chinese government to boost the economy. Well, Unfortunately, that didn't happen. At least it hasn't been announced yet. But they are talking about supply side reform to drive the development of strategic industries. So on the supply side, they are trying to, they're talking about boosting their AI sector, boosting their semiconductor sector. One big development is that they are trying to move revenues from the central government to the local governments. Local governments have been more affected by the real estate problems because they used to depend on land sales quite a fair bit for their revenue to spend, right? So that has gone away. A lot of that has gone away. So in return, the central government is looking to move some of its tax collections to the local government level to ease its problems. And the central bank has also cut the policy interest rates since, right? So I think it bears watching going forward over the next 1-2 weeks, because the third plenum, what was announced so far is just a broad direction, but the specific measures will be announced over the next 2 or 3 weeks, right? So why China in that sense, right? Broadly speaking, I think I've talked a bit about that China is a mixed bag, but I also hinted that, of course, when everybody knows the bad news and when it's sort of priced in, to what extent, well, it is for you and me to see, but I think it's broadly well understood about China's problems. But here I will just talk to you about some things to appreciate about China, right? On a more structural level, maybe more medium to long term, you appreciate its various characteristics. Then, first of all, China is already the world's largest GDP country by purchasing power parity, right? In 2016 onwards, the weight bar is China versus the US. If you adjust for purchasing power parity, it's already the largest in the world. What's purchasing power parity? That means basically you adjust the dollar amount GDP by the actual paid purchasing power that $1 of GDP can purchase in actual goods within that country, right? So that's basically the actual purchasing power of that $1 of GDP, what that means. So that's what is people talking about when they say PPP adjusted. So China has been trying to move to a more domestic consumption-driven economy, right, over the past few years, what they call a dual circulation economy, right? So this gives some confidence that the transition should be at least they have a critical mass in order to effect this transition. Okay. Stock market wise, China is already, I guess you would say, the world's second largest stock market by the value of the companies listed inside the stock exchange, right? What is shown here is Shenzhen and Shanghai and Shenzhen Stock Exchange. They are respectively the world's 4th and 7th largest stock exchanges. And that's excluding Hong Kong, right? Hong Kong, if you exclude that, if you include that, even bigger. By stock market total value as a function of GDP, the US is stock market value versus GDP is 200%. In comparison, China's corresponding number is between 70 to 90%, right? I think Warren Buffett has some indicator, right? He used to compare the stock market value versus the GDP. Anything above, say, 100% or above around there, he considers that he may not want to buy stocks during that period, right? So that's here we are sort of using the indicator to measure these two countries. So research and development. So the key thing to note here is mainly that whether you look at R&D spending on an absolute value, so here it's showing by billions dollars. Whether you're talking about R&D spending, where you compare China and the US, or you're talking about R&D, the results of R&D, that means the papers that they come out with, the share of global high impact papers. China is actually one of the world's largest, is comparable to the US, right? In terms of both input and output on the R&D end. Now I talk about the capital markets, that why China shares, right? So this A good reason is that China A shares. So China A shares, I will explain more in detail later. What you know typically may trade in, for example, Alibaba, Tencent, and all those in Hong Kong, right? Those are typically known as the China offshore shares. China A shares is the China onshore shares, right? Those that are traded in the China domestic market, those are known as the China A shares. Well, for China A shares, the correlation of these A shares versus the various major stock market indexes, such as the S&P, such as FTSE 100, or so on, or the Nikkei, the correlation is relatively low, right? Anything below 30% is low correlation. Anything above 70 to 80% is very high correlation. What is correlation? Correlation means when one market goes up, the other market, how is it expected to behave? If it's high correlation, means both markets expected to move in unison, which is not good for a portfolio, because when you have a portfolio, what you're trying to do is to have a diversified portfolio so that they sort of cancel each other's out, and then your portfolio's volatility is mitigated, right? So that's one of the positives about China A shares, low correlation with major markets elsewhere. Second thing is, of course, that China's equities, if you look at the dark red line here, as measured by the A50 index, which is basically the 50 leading A shares on the China's stock market. Well, it compares, it is, as you can see, it's low PE ratio versus markets such as S&P, or you're talking about the Nikkei, over 20 times PE. So China's A shares is about below 10 times. And that's comparing across regions, but also on a historical level, right, is also quite low compared to, say, of just 2 years back, right? This is just the government's, just to give you an appreciation for the China market. The China government, it has the world's largest forex reserves, and it is also quite low in terms of the government gross debt versus the GDP as a percentage compared to other economies. So the key thing here is to tell you that if they wanted to stimulate the market through some mega stimulus package, they could, but they are choosing perhaps not to. Perhaps they are looking at it over a extended period, perhaps to prepare for a new US president. Maybe they have some additional packages up their sleeves, right? China A shares, I just want to highlight the pie chart here. If you look at all the China shares that are listed globally, including the domestic as well as the offshore shares, the domestic A shares actually comprise more than 3/4 of the total by market value. So if you wanted to look at China, what I'm saying here is that you should and you could now look at invest into this sector because this is actually where the broad value of the total value of the China's industries and companies where they are listed in on the domestic market. Right, and just to give you a brief flavor of some of the companies, major stocks that are listed on the A shares. H shares, everybody is familiar, like Tencent, Alibaba, ADRs in the US. I guess some of you might also be familiar, right? The key thing, I guess, is also that the beneficiaries of China's economic transformation, a lot of them can be found in the China's A shares market, right? This one I'll cover more in detail when I'm talking about this. So I will save that for later. So here I'm going to be talking now about our Phillip-China Universal MSCI China A50 Connect ETF. If you look at this product, actually it's a collaboration with China Universal, which is a leading mainland China fund company, right? And it is basically benchmarking this MSCI, is the index provider, China A50 ETF. So basically, A50 is the leading 50 stocks on the China A shares market, the domestic onshore market. Okay, so that's how you can interpret the name. Okay, the structure. This is how the structure is like. Basically, this is what is listed in Singapore. So what we do, we don't actually buy the underlying 50 shares. What we do is actually we just buy an existing ETF that is run by China Universal on the Shanghai Stock Exchange, right? This is now facilitated because there is a SSE SGX ETF link that was established and formalized by MAS and SGX. So that is the link that we are running on now for this ETF. We don't have to buy all the 50 stocks. We just buy an ETF that tracks those 50 stocks. So in that way, both the master and the feeder ETF in Singapore are able to track the benchmark ET index, which is the A50 index. The key thing, I guess, to highlight is that in the past, it used to be difficult for people to buy into China A shares. Of course, then there was the Stock Connect in Hong Kong, where you can do that now, right? You can buy into China A shares through Hong Kong Stock Connect. However, here we are listing a product in Singapore in Sing dollars, where you don't have to necessarily go to Hong Kong in order to buy China A shares, because now it is convenient and efficient. You can just buy into this ETF in Singapore using your natural Sing dollars in order to access the 50 leading stocks in the China A shares market. So that's the key value proposition for this ETF. Just to give you an idea of how this MSCI China A50 index is compiled, okay? So the parent is, the starting universe is the China A market, China A shares market, thousands of stocks as a start, okay? Now, typically for a normal market cap weighted index, you would basically weight the stocks based on, you typically select and weight the stocks in the index based on their free float adjusted market capitalization, right? So typically you would do that, right? So that is also done here for part of the stocks. But the way for this index in order to ensure that there is adequate cross-sector representation, what it does is before this is done, the index provider actually makes sure there is 2 sector leaders from each of the 11 gig sectors, right? The 11 major sectors. For example, the gig sectors could be industrials, basic materials, financials, technology, right? In utilities, telcos, and so on. Okay, so two of the biggest companies in each of the 11 sectors, they are first and should to be inside this index first. So 2 times 11, basically there will be 22. Then, in order to make up the 50, then the remaining 28 is selected just based on the largest market value, right? So basically that's how this MSCI A50 is compiled in order to arrive at the final constituents. So basically that is how it's done. And ultimately what you get for this ETF is therefore, there is first of all, there are the core assets. That means the biggest companies in each of the 11 sectors typically. Second thing is, of course, sector exposure is well balanced, right? Because of the deliberate index methodology to ensure sector representation. So for example, you can see that as of the last update, none of the sectors has more than 20% of the whole index or the whole ETF, okay? And the top 10 stocks actually comprises near 50% of the total, okay? These are the top constituents, and just to give you a flavor for what is their sector, as well as each of them are basically leaders in their respective industries, right? Some of them may be familiar to you, such as Guizhou Maotai, right? The spirits leader. BYD, leader in cars, electric cars. CATL, leader in electric vehicle batteries. Some of you some are not so familiar, but that's exactly the reason why you want to buy an ETF, right? Because what you don't know may actually do better than what you know, right? And for a large market like China, right? Some of these sector leaders, like Zijing, Wanhua, Luxshare, they're actually leaders in their respective fields. So this, for example, Zijing is a top 5 leader in a global basic material mining, such as copper. Okay, Luxshare is a big manufacturer of components for Apple in China. Foxconn will benefit from because what they do is robotics and so-called industrial internet, the cloud of things in manufacturing, which is exactly what China's government is trying to promote now, smart manufacturing. So basically, but through this ETF, you'll be able to access this very conveniently. You may not want to do that much research into individual stocks for China. You just want exposure to China at a valuation or a point where you think is reasonable. And definitely, I think if you look at valuation, I guess China is definitely a better point than, say, 3 years ago, 2 years ago. Okay. Now, finally, I just want to give you a flavor of this is the performance of the various China-related indexes, right? Various indexes that track China's shares over the last 10 years, 2014 to 2024, the performance. So the index I'm talking about, which is the red line, MSCI China A50, is the red line. So that has delivered something like 80%. The few around here are all tracking China A shares, the domestic shares, but I just want to also draw attention to the gray ones that have underperformed over these 10 years. Basically, they have the gray line, if you look at these two, right? Basically, they have gone from 1 back to 1. Basically, effectively, what it means is delivered near negligible returns over 10 years. And this is the China all shares. It's not China A. Yeah? This dark gray line is China all shares. The light gray one is MSCI China. What do they track? Basically, what they are trying to track is the entire universe of China shares listed across domestic China, listed in offshore China, listed in the US, listed in Hong Kong. Well, guess what? Basically, the offshore shares have not delivered long-term return at all. But if you invested into China A shares, just the domestic part alone, at least you get reasonable returns over 10 years, 80%. So I'll just end this slide. If you wanted to find this ETF, it's listed on the S-Reits. The ticker, you can just find MCN, 3-letter ticker, then you can find it. Underlying is 50 A shares on the 50 leading A shares on the domestic China exchange. So with that, I think I will end off and move on to the next part that everybody might be waiting for.
Right, thank you, Mr. Tan Teck Ling. Please stay on stage. We will have the next segment, all right, which is actually the lucky draw. All right. So for the lucky draw, all right, this is the 4th and the last lucky draw before the grand lucky draw later. Right. So we will have the Kahoot quiz before the grand lucky draw. So like I mentioned, do keep your bingo card with you at all times. All right. So now we invite Mr. Tan Teck Ling to draw one number. Can you just shuffle around and draw one? All right. All the best for the 4th lucky draw prize. The 4th prize will be actually also a Polaroid, but this time it's a photo printer. Right. So it's worth 169. All right. So this is basically the Polaroid High Print Gen 2, 2x3. Okay. So it's a bit long, the name, but then basically it's just a Polaroid printer for photo. Okay. Okay. Back to similar to the AM session. All right. So now we have a 3-digit winner. First digit is 1. Right. So 100 plus. So if you're above 150, you can listen up. You might be the winner. The ticket number now for the 4th prize is 176. Is 176 here? Oh, in front, right in front. I think I need my colleague. Yes, he will be coming down to hand over. All right, so congratulations for winning the lucky draw number 4. All right. Okay, so do take note. The first to 4 winners, later I will prompt you when to come down to collect the prize also. All right, so the next segment that we will have all right, will be the panel discussion. All right. So together we have we have a moderator along with 4 other speakers. Right. So Mr. Kang Wei-Jin, all right, Associate Director of Securities Trading Equities for SGX Group, who will be the moderator. Then we have Raphael Goh, who is the Vice President of Intermediary Distribution for CSOP. Mr. Lim U-Jin and Mr. Ong Jun Xiang and Mr. Tan Teck Ling. These are the 3 speakers previously as well from the respective ETF issuer. Right. So welcome on stage for the panel discussion. Give a warm welcome to them. Thank you. So as they take their seats, the panel discussion, their discussion will be regarding the future of ETF, emerging trends and hidden opportunities, and the power of DCA. One more thing to note is, I think on the 2 screens on the left and right, you will see that there is a QR code for the pigeonhole for you to scan right now and to ask questions. Right. So this is somewhat like a Q&A. Of course, they might not be able to cater to all questions, but do feel free to add in. For the online participants, you can also scan the QR code to add your questions in. All right. Then you can actually ask questions that you might have along the way that you actually want to ask them just now, didn't manage to ask along their presentation zone. So now I'll hand the time over to Wei-Jin, who will moderate the session. Thank you.
Thank you. Yeah, and very good afternoon to everyone. This is Wei-Jin. I'm in charge of the ETF business at SGX. So we are pleased to have all you here today, and it's great to see you staying through the entire day. We are getting quite close to the final draw, so do hang on. So this panel discussion, we will try to sum up all the sharings and I think what you have learned earlier throughout the various presentations. We hope that this panel discussion can hear the views of certain questions directly from our key speakers today and panelists. During the session, you're also welcome to submit any other questions you have. We have prepared a few questions, but if you do have any questions you want to ask and you want to help others to understand better, do scan the QR code on both sides of the auditorium. This will provide you with a web page whereby you could enter your questions. So without further ado, I think by now you will have heard from most of our speakers here. Raphael, he didn't present earlier on, but he's also our key panelist today from CSOP. And we've been working with him closely and also educating the local investors on ETF investing. So without further ado, I'll start off with the first questions. In fact, if you were here earlier in the morning, I think our market strategist, Jeff Howey, has given everyone a very good, I think, history and also the current trend of the ETF market. So we have our first ETF more than 2000 around year 2000, more than about 20 years ago. And since then, we have seen an expansion of ETFs into key asset classes, gold, fixed income, REITs, this example. So I would like to add probably the first question I have for the panelists, your views on why over the recent years it has gotten so popular. And I think most people in this room will have known what is an ETF by now. And maybe also on a more personal note, which was the first one you got in touch with, and also how has things changed since the first time you invested into ETF? Maybe I could start off with Raphael.
Yeah, hi everyone. Thanks for staying through, and thank you, Securities, for inviting us on this event. Okay, so basically, I think the rise of ETF that we are seeing right now is ever since probably you will see the trend starting 2017, I believe. During that period of time, it was when I just started out my career in sales and trading as well. So during that period, we saw quite a few fintech companies coming into Singapore, and not just Singapore, but within the region and over in US as well. There was also a rise of all these robo-advisors that we're seeing in the markets today. And for ETF-wise, being robo-advisors, the rise of internet broking platforms, cost has always been an issue for them. And always they think to drive costs lower, and which is why I think during that period of time, they were selecting some of these investment solutions for their target audience. And when cost coming involved, in their mind, ETF would be perhaps the right vehicle for investment, or for those who are not financially literate. That would be the most simple way for them to access the markets without too much of scrutinization of the underlying itself. And next up, in terms of the first ETF that I exposed and I actually own, because I was in the sales and trading platform previously, I was doing sales and trading. Actually, I come across various of ETFs since my clients trading leverage and inverse ETFs, getting themselves invested. Some of the CIOs themselves, they are invested into broad-based index ETFs, which are likes of MSCI, Asia X Japan, STI ETF as such. So from that perspective alone, I did follow because one of my clients was one of the CIO of this family office based in Singapore. I had a short conversation with him. He shared with me is that you don't have much time to look into the underlying. Just look at the index, broad base. If you like it, you should just stay invested and keep a diversified approach. And that's where I started off with STI ETF and then MSCI Asia X Japan back then.
Thanks, Rafael. I'm here followed by Teck Ling. Would like to share a thought. So Teck Ling is the Deputy CIO of PhillipCapital Management.
Yeah, I guess the trend typically, as with a lot of financial products, starts in the Western world, right? US, and today, I guess in the US, it was reported just a few years back, the share of assets in ETFs has already exceeded the share of assets in mutual funds, which is what we know as unit trusts. So ETF is a phenomenon over there. And increasingly in Asia, I think that has also taken root. I guess, people over the years through new structures and companies such as robo-advisors, right? So this has also helped to popularize the concept of building a portfolio with ETFs. You don't just look at stocks alone, right? Or you don't look at mutual funds or unit trusts alone. ETFs can be an effective building block to effectively get exposure to a given market. It's convenient, so that's one that is a reason for its popularity. Second reason, I guess, is it's transparent. It is you know exactly what you are buying into, right? Not so much a unit trust, I guess, because sometimes you don't have exact insight into what the fund manager is doing. So I guess for those who want to take the investments into their own hands, an ETF is a transparent way to do it. And I guess the thing is also that because you can actually trade it on exchange just like a stock, right? It's very easy. You can get in and out at whatever price you want within the intraday period because that is quoted just like normal stocks. Second part of the question, I guess, I think I bought my first ETF, which was a gold ETF, right? That was around just after around 2009, 2010. So I thought maybe it was a good time because the amount of money printing that was going on, eventually that would translate to, inflation and benefit commodities such as gold. It wasn't a good experience because I think I was not patient enough, right? So in the end, I just exited with marginal gains, maybe even a loss, I can't remember. But I think, if I had waited longer, it would have been a different story.
Yeah, thanks, Teck Ling. In fact, Gold ETF is also used actively by our institution and retail investors. Simple reasons, because I think for those of you who have bought physical gold, probably it's not as convenient as buying a stock, right? You need to look for a particular trusted parties or banks or bullion house to purchase it, and they may come with pretty high transaction cost. But in Gold ETF has garnered quite a bit of popularity since its debut, due to the convenience of trading and buying it like a stock. Maybe for Shin Xiang, U-Jin, your story on the first ETF you own.
Okay, so in terms of ETFs, I feel they have three key benefits, which my fellow co-panelists have already mentioned. First is about low cost. Second is about liquidity, because it can be easily traded in and out on an exchange like SGX. And third is a feature that's been ignored so far. Actually, it's something a lot of institutions value. And this is called diversification. So three things: low cost, liquidity, and diversification. And in fact, one of the first few ETFs I've owned around more than 10 years ago was actually the STI ETF. Because I'm based in Singapore, Singaporean, then if you think, wow, since when you are young, then you heard about STI. And I equate and feel ETFs are a bit like Lego building blocks. You use it to mix and match to build your own portfolio. But since then, my portfolio has also evolved further, evolved beyond STI ETF already to include, for example, a greener version or more modern version of the STI, for example, like the Singapore Low Carbon ETF. Also diversified beyond the 3 local banks to include APAC Financials through APAC Financials ETF. So to U-Jin.
Yeah, I think everyone, the fact that we have 4 different ETF business development directors, CIOs sitting here talking to everyone is testament to the fact that it only took 30 years as an industry for ETFs to overtake in a way the unit trusts. And I know it sounds a bit cheesy, but I thank the audience, right, for looking at ETFs as a avenue to really gives you the best sort of like bang for your buck in terms of investments, diversification, lowest cost. And also the fact that we have all been hitting the ground over the last, 7 years. Combined, I think we've got, 50 years if we are very old of experience, right? Or more. Talking about ETFs, right? So it's both the fact that the ecosystem in Singapore has grown so much over the last 10 years. Right. If our partners here, if Securities, partners like Securities, if SGX and ourselves, we were not doing it together, we wouldn't be talking about why ETFs are so important in your investing lives at any one point of time. That's the first point I want to make. Second point is that my first exposure to the ETFs were actually the Lion-Phillip REITs ETF, because simply put, I was in SGX at the time. There was a gong ceremony, and I watched them hit the gong, and right, and it's simple as that. And why did I continue investing in ETFs? Why not single stocks other than diversifications? Sometimes it goes down to a very simple reason. In my case, it was compliance approval. Who works for a financial institution here? Okay, other than the Lion Global people, right? Other than our friends and partners. But sometimes it's as simple as that. A simple product feature. We're not even talking about investment thesis, exposure, portfolio construction, right? It's just, should I buy a single stock and all the hassles that it has to go through, or can I just buy an ETF at one shot? So I think those are the 2 points I want to make. Thank you to everyone here. Thank you to you guys in the audience as well. Thank you to SGX. We've come a long way. And I think we still have quite a bit more to go, and we're very excited about it. Yeah.
Thanks, U-Jin. Yes, Lion-Phillip S-Reits was launched before I joined, but I did hear a story that it was a very successful IPO. People are queuing till midnight to get subscription. And we are thankful to have such innovations. Nonetheless, we do know that the REIT sector hasn't done well in terms of returns lately because of rates environment. But we did see that in the first half of this year, actually, REITs and fixed income ETFs, these are the newer innovations compared to equities, has garnered a lot more interest. Retail investors trading REIT ETFs jumped by 50%, fixed income 30%. And I think today we have both speakers from Nicole AM, U-Jin, and also Lion Global Investors, Xinxiang, that have done a bit of sharing in terms of the products that they have. Of course, Bruce, who was from CSOP, also shared about the REIT sector. So these are very closely related to REITs, which is very close to our hearts, and also fixed income. So may I first direct these 2 questions to U-Jin and followed by Rafael. Right? What do you think has driven the interest in REIT ETFs lately? Fixed income ETF as well. So since they were launched in probably, I think, less than 10 years ago, how have you seen the adoption evolves? And what should investors take note of when they are buying into such products like a REIT ETF or bond ETFs?
Okay, maybe I'll start with bond ETFs, because I think that's what I spoke about. If you managed to attend my session just now, and Bruce and Rafael they'll talk about REITs. So fixed income, I like to say that in 2022, did T-bills, who has invested in Singapore Treasury bills? In the last, who invested more than 5 years ago in T-bills? Okay, so 2 years ago, T-bills, raise your hand. Okay, about 20, 30, more than 5 years ago, T-bills. I just see one hand there, right? So I'm a bond ETF business development director. They always ask why bond ETFs versus T-bills, and I came after 2 years of hitting the ground. I think of T-bills as the Chris Hemsworth. If you know the Hemsworth brothers, Australian actors, he's the more popular one. He's the good-looking one that everyone is talking about. T-bills. Then bond ETFs were from the same family. The underlying is the same. That's not as popular. A bit more difficult to understand. No one really knows who Luke Hemsworth is or Liam Hemsworth, right? But yet the underlying is still the same family. But because there's so much interest in T-bills, I think that's really the question that Wei-Jin is asking. How has that translated to bond ETFs? Really, because I think it's a complement. As a structure, you're still investing in roughly the same family. The risks and rewards are roughly the same. But then because bond ETFs, there are some complexities, but there are also some benefits involved. We have benefited from that rise in your knowledge and understanding of what a fixed income investment was. My job would have been so much more difficult if I was the BD guy 5 years ago, because of an audience here of 250 people, only one person kind of may have more advanced understanding of fixed income. But today it's easy. And I think that's really driving interest in bonds. And that's the good part, right? But the bad part is that why has T-bills, why has fixed income as an asset class become such a big problem? Because on the ground, we are facing inflation. And that's what central banks have been trying to tackle and dampen down over the last 2 years. So I think it's a mixed bag. It's because of a problem which has led rise to a lot of interest in an asset class that was not very popular, but in a way that's also good in terms of understanding, investor understanding of a slightly more difficult to understand asset class, right? And this is a journey that we'll probably have to continue, because what's going to happen next is what next, right? If the inflation cycle starts to turn, I think the next question is, if it's peaked, is it going to come down? And if it's going to come down, is it going to come down back to, the generation of low, zero, or even negative interest rates, right? So that's something that we have to tackle. But I'm confident that the ETF industry as a whole, as product issuers, new advancements, we'll have more products to meet that needs as your investment needs evolve.
I mean, for Rafael, since we know that REITs, many of the local REITs are diversified in their own, right? And a lot of REITs are diversified REITs. So why do we still see investors going to REIT ETFs, which adds another layer of diversification on the already diversified portfolio?
Okay, so before I answer this question, can I show of hands how many of you have are holding on to individual REITs counter currently? You see, most of them. Okay, so the other question I'm going to give it to you is that how many of you, when it REITs issues, rights issue, how many of you got burnt or you have to find headache dealing with such issues? Like, for instance, having to subscribe to the rights issue, lowering your cost of the current outlying share prices. These are all headaches for the current investors at this current juncture. And as we speaking, holding on to individual REITs themselves, they have diversified underlying properties. You're not wrong. But some of them are specific in terms of their sectorial exposure, which is why we always emphasize when you are invested in REITs itself, it is always good to be diversified in terms of not just the properties exposure, but also looking at the sectorial exposure, the country allocation as well. These are a few sectors that I think when money flows, you'll be still capturing all these flows within the money market movement. And with a REIT ETF, this will allow you to be able to keep track of that.
Yeah, thanks, Rafael. Maybe I'll move on to the next questions. For those of you who might not be watching the market closely, we have seen STI hitting a multi-year high, historical high lately in the first half 2024. And of course, besides the two STI ETFs that we have on SGX, we do have other Singapore-based ETF as well. For example, a few years ago with Teck Ling, we have launched the first Singapore Sing Income ETF that focus on the high dividend paying Singapore listed companies. I'm not sure how many of you here have subscribed to it, but since then, I think you have decent traction among investors looking for income. And lately, just 1 or 2 years ago with Lion, we launched, probably have shared earlier on, Singapore Low Carbon, which then offer a bit of a climate tilt toward the Singapore companies. So maybe my question for this will be directing towards Shin Xiang, followed by maybe Teck Ling as well, and U-Jin, because we do have Nicole STI ETFs. What do you think such thematic ETF, or how have they performed since their debut? And also, what role does a broad-based Singapore vis-a-vis income Singapore, low carbon Singapore should play in investor portfolio? Because obviously I only have so much money, right? And how much should I put in each of these themes? Maybe some sharing starting from Shin Xiang.
Thank you, Wei-Chin, for highlighting our Singapore low carbon ETF. So it's great to hear that the STI has been hitting new record highs, like what Wei-Chin shared. An interesting thing is it has been actually hitting record highs because of the 3 local banks that have been doing well. So because of this, we have seen improving net interest margins among all these banks. On the flip side, it is also good and important to consider diversification in 3 different aspects. GSS, easy to remember, Great Singapore Sale. G for geographical, because if you include constituents that are listed beyond Singapore, for example, like US or Hong Kong, you may get a more different performance outlook. Sector, because if you have include and greater allocation to the tech sectors that have already seen a rally, could be beneficial for a portfolio. And also securities, because the STI in fact was constructed back in the 1960s when Singapore actually just went independent. So because of this, that's why we were thinking back then, maybe we could construct a more modern version, 21st century version, and also a greener version, because decarbonization was the upcoming trend of the STI, to offer investors another low cost and affordable avenue to assess Singapore's domiciled companies, not just listed within Singapore, but also listed beyond Singapore, for example, like US and Hong Kong. And since its inception, we have also, we're glad to share that the ETF actually has outperformed the STI in the past few years, since inception on 28 April and 2022. So I think it's a good way that and also to signal that you do not actually really have to sacrifice returns when you decarbonize your portfolio within the climate change action.
Maybe I move on to Teck Ling more on the Sing Income and how does dividend plays out?
Yeah, so we have this Phillip Sing Income ETF that buys into Singapore stocks as well. We launched it in 2018, late 2018. So now he has over 5 years of track record. The way that we constructed the index is it wasn't licensed off an existing index, so we actually worked on this designing this index with Morningstar for this Phillip Sing Income. And what it does is it tries to pick out quality, high dividend, blue chip companies. So starting universe is still based on the biggest companies in the Singapore Exchange. But we try to apply certain filters on it to make sure that what comes out, the constituents of the index would be so-called quality companies with solid cash flow, dependable cash flows. Doesn't like fluctuate too much. They have a strong balance sheets, so they won't they don't have financial problems in adverse economic times. So basically, it's along our theme of what we are trying to develop in our REIT ETFs previously. One of them is with Lion, the S-Reits ETF. We did this one also along the theme of trying to develop income-focused kind of ETF, right? So this one is our take on an income-focused ETF focusing on the Singapore market.
One interesting fact on the ETF, Teck Ling just told me a few weeks ago, it has Great Eastern in one of the constituent. which probably makes it quite a different ETF compared to the STI. And maybe lastly to U-Jin, maybe right, you have the last word here on STI. So what role does it play with among these thematics and dividend play?
No, so two things. I think a rising tide lifts all boats. And well, we were the first. I think it's just because historically we were the first. No, second, sorry. So there was the State Street STI. For some reason, we thought we would also want. Well, Nico M used to be DBS, and I guess DBS needed to have an STI ETF. I think that's the reasoning, right? Corporate, right? It's just a Singapore story. But we're not apologetic that we had the first or second STI. But a rising tide lifts all boats. Just because you have got, let's say, a restaurant. I've got a friend who's a restaurant owner, and he says that in my dessert menu, I must always have one of the basic desserts, like a simple chocolate cake or a vanilla ice cream. Because 70% of the time, people who are uninitiated, who do not really know what they want, but want to just have a piece of dessert, they'll go for the plain vanilla option, right? And just because we happen to be at the choice earlier, right? No fault on anyone, no fault on us as well. It's just the case. But then, as I said, as markets evolve, I'm actually very happy that there's actually more interest in ESG, low carbon, climate changes. Why am I a lot more happy now? Because on a personal level, when you've got kids and you think about rising sea levels and where Singapore's place literally, in a world with rising sea levels is, do we need to be more conscious about where we put our investment and our dollars, right? So I'm very happy that there actually is more interest in products that give you certain aspects that should be important to you. It's important to me, it's important to everyone here on the panel, right? If dividends is important to you, then I'm also very glad that other than the plain vanilla option, if you want something else, that's also good for you. And once again, it goes back to the very first point I mentioned, more interest in all of our products is good for us as a whole. That's why in another 30 years time, right? Maybe the question now would be, no one has been able to displace the ETF market, right? Where do you see yourself from there? But that's a good problem to have.
Yep. One final point to make. So you can imagine STI is like the chocolate cake, but Singapore low carbon ETF is like matcha chocolate cake.
Yeah.
Green version. So for easier memory, easier reference.
Yeah.
Matcha chocolate cake. They coexist, both are tasty.
Yeah.
Go ahead,
Just
Raphael.
want to add a little bit more. Okay, so for low carbon wise, I think most investors here, can I have a show of hands? Does the negative connotation of low carbon comes into mind? Because right now I can share with you, over an SGX, one of the best few performing ETFs are actually with low carbon in their name in it. And also over an SGX beyond Singapore, and we have one of the, I would say, Singapore's biggest secret is CSOP APAC low carbon ETF. In fact, it's also one of the best performing ETF on over listed on SGX. I think year to date it's up over 40%. And basically because of the underlyings itself are Asia Pacific corporates with the likes of your Toyota, your Samsung, TSMC, and as such. And interestingly, I think the low carbon is just, I would say, ESG themed named over it. But I think the real name is for such product should be, it is considered as a quality select product, because such of these companies, they are screened through a more stringent process compared to the rest. And you can only imagine that only companies that pass through these stringent processes, they are definitely or generally or most often than not the cream of the crops.
Thanks, Raphael. Yeah, indeed, I record that ETF do have like a 40% exposure to Japan. So for those of you who are looking for Japan exposure, actually that one does has some coverage. And the best kept secret is that all these are available under Phillip Share Builders Plan. So if you do want to get started in a DCA manner, that's a good way to get started on those ETFs. Maybe moving beyond Singapore, and I was here for Paul's head of research, Phillip Securities sharing earlier on. I think if I'm not wrong, the outlook to China isn't that great according to his sharing. So probably now we do have a few issuers here. In fact, all of them here have some ETFs that are related to China. So they must know something that probably I wouldn't know. So I'm going to start with probably Teck Ling, right? What investors should take note of? Maybe before that, I asked this last week as well. I'd like to know who are holding stocks that are related to China now. Hong Kong, ETFs, China A shares. A show of hands, be honest. Okay, probably close to 20%. The other time we had 80%. But that was the how to navigate through China seminar. So with Teck Ling, maybe you can start off. What should investors take note of? For two-type investors, those who are already invested in China and those who have not yet invested into China.
Well, I just presented before this panel about China. So those points are already made. It is a rather mixed bag. The risks are well published and possibly well valued in. I think the fact that a lot of institutional investors are light on China may be a good thing. That means that if they wanted to buy back into China, there will be resultant inflows. So always, I guess, look on a flip side in a manner that is possibly, I guess, apart from the public thinking. I think that it would be how I would suggest the investor to think. You may want to, for those who are already in, then I think it may probably just make sense to hold on because, like I said, you are already in the situation is such that the equities, the exposure you are in for China is it may have already dropped somewhat, quite a fair bit, right? And the valuation is probably quite reasonable now in a sense, right? Whether it's stocks or you're talking about ETF or whichever, right? And for those who are not in, or maybe generally as a whole, you could if you wanted to get exposure to China, right? Let's say you are generally positive on China. Well, there are a few ways to do it. So here I'm talking about the approach to it, rather than should you go for China or not China. But here I'm looking more at the drilling down to the second level. What is the ways that you can do it? I guess it is possible to diversify over time and space. What do I mean by that? So basically, time. You may not want to time the market. You could ease in over a period. So, ways such as, I guess, was mentioned, share builders plan. You just have a regular portion of your income going into the various investment instruments that you want to funnel it in over a period of time. So you don't want to time the market at one particular lumpy point, right? Unless you are particularly convicted. That's what I mean by over time. Over space, meaning over a basket of stocks. Don't try to pick. So there is one approach that people generally advocate, which is to use ETF as a building block for your intended allocation. So what is called a core satellite portfolio. If you wanted to have, say, a key part of your portfolio as China allocation, right? The rest could be US and so on. But let's say China, you designate it to be part of your portfolio. Then an ETF that is reasonably well diversified, say, an ETF of leading China stocks like what I just presented, that could be a core part of your China allocation. And then you want to select individual stocks that you are particularly convicted on, that you believe strongly in, that forms your so-called satellite. So, a core ETF surrounded by satellite individual stocks. That could be how you approach your China allocation if you wanted to allocate.
Thanks a lot, Teck Ling. And maybe I give some time to Rafael as well, because CSOP pretty have an extensive global suite of China-related ETF. In Singapore, recent years have been launched dividend focus, and so one that is tech, semiconductor focused ETFs. So maybe for Rafael, what's your view on such thematic play in today's environment?
So I think for China, it boils down to one thing. The government policies and the government initiative. So for those who want to get exposure in China, I think the keynote here is to always focus on the government's initiative. If the government is going to expand their semicon manufacturing capabilities and be sure that they will be putting in a lot of effort on it, and perhaps that may be one area for you to look at, perhaps certain ETFs that focuses on their technology. The other spectrum to look at is also if you understand the Chinese government and how the businesses there work. Mostly, if let's say you want to get a safe dividend payout, you can consider certain ETFs that focus like our SHD, the Shanghai Dividend ETF, which focus a lot on the state-owned enterprises. And these companies generally are state-owned entities, and they will pay regular stream of dividends on the end.
Yeah, thanks a lot, Rafael. So we have some time. Now we will be moving on to the questions. We have like a lot of questions submitted, about 30 over of them, or nearly 50. So maybe let's move on to some of them that we have top votes. The top one is interesting. With ETF around, will they progressively replace unit trust? It's a far lower cost option, and do we still need unit trust? Maybe I give this question to Teck Ling, because PhillipCapital management, as we know, they do have a wide range of unit trusts as well. So what's your view on this?
Well, yeah, so that's correct. One of the positive points of ETFs is that they are lower cost, right? Low management fee. Do we need unit trust? So I think there's always a space for both kind of products, right? ETFs, you are trying to track a certain benchmark, right? Unit trust is trying to do better than the market. It's just like saying, is there no space to do stock picking, right? It is not really true, right? If it's a situation where you want to do better than the market, right? You have looked at this fund manager, and they have a good track record of, they have a certain edge in their field of expertise or their investment mandate for that particular unit trust. And of course, that is the reason why a certain unit trust has a long track record, because they have a track record of delivering alpha, which is basically the return in excess of the benchmark that they are trying to track, right? So, I actually tend to think that, for example, if you have ETFs and then ETFs become the predominant instrument across the whole market, there should be even more space for stock pickers, right? Because the ETFs would be tending to track a particular field of stocks, and therefore the ones that are missed out, not within the universe for whatever reason inside these ETFs, they will be unfairly cheap, right? And that's probably where active stock picking can come in, whether in the sense of unit trust or whether in the sense of just buying the stocks yourselves, right? I think there's always room for these few kinds of approaches.
Yeah, thanks, Teck Ling. Anyone to add on?
Okay, I can add on. So similar to chocolate and matcha chocolate, ETFs and unit trusts are also similarly able to coexist. Because for unit trust, sometimes because I also do both product and sales. So from product perspective, you also, from unit trust, you need to open all the market accounts. For ETFs, you open market accounts, but sometimes for some specific strategies, right? The underlying market, actually, they can be more illiquid. So it can be actually, from ETF perspective, the key advantage, one of the key features is actually liquidity. But it might be hard to actually, for market makers to market make and provide liquidity. So because of this, for some specific strategies, it could be better to launch in a unit trust form, because you don't need to provide so much liquidity on the exchange to make it readily priced. So this actually makes it sometimes more favorable than an ETF form. But on stuff which actually have more liquid constituents, maybe ETFs could be better, because they allow liquidity for retail investors like including myself, to be able to access in and out. So actually both can exist, like chocolate, matcha chocolate. It depends on actually more on your preference, which one you feel like eating that day. And then after that, you purchase, and also which one you feel like exiting to reallocate some of your portfolio monies to.
Yeah, thanks, Jun Xiang. Maybe we move on to the next question that has garnered the top votes. Okay, I have it here. With ETF around, sorry, not this one. What should be a minimum ETF portfolio that investor must have in SGD, and what percentage of capital allocation? So probably this audience asking how much allocation should be in Singapore related ETFs, and how much probably non-Singapore. Maybe we can start off with U-Jin. What's your thoughts on this? How do you diversify between Singapore and non-Singapore?
Okay, so maybe the framework, I'll frame it in just two simple investor types. One, if you are looking for growth, maybe, and then one for income. All right, this is just very simple. My panelists, you can also jump in. Let's just say classify, you look at the US markets more for growth. Just simply, right? US markets, the S&P 500, or maybe even the QQQ. So NASDAQ, right? You're looking for growth. And then the poster boy for income could be a REITs portfolio, Singapore REITs, or the STI, right? Whether it's matcha or plain vanilla, that's up to you. But generally, right, I would say let's generally classify STI as income. And so then I think the reason why this question is difficult for any of us to give you an answer is because we do not know your specific investment needs and what is your specific investment horizon. Once you understand that, then you can decide whether a growth portfolio is more appropriate or maybe an income type portfolio. So generally speaking, rule of thumb is if you're younger and you've got a longer runway in front of you, you've got maybe you're planning at retirement in 35, 45 years time, you still have a long way to go in front of you. Maybe you can take on more risks. You can stomach more volatility. So you could look at just generally US stocks or growth type of investments, whether it's unit trust, whether it's ETFs, etc. Then if your runway is shorter, for example, or if you cannot stomach risk, right? For example, you're close to retirement, and if let's say you need the money, and tomorrow the next global financial crisis comes, and you cannot take a hit of 30% on your portfolio, it's very painful for you. Then maybe something that exhibits less volatility, right? That can give you that clip. Every semi-annual distributions, roughly is about 5%, 4 to 5%, and you're okay with that, then that's probably more suited for you. So it's along those two spectrums that you can play around. So that's how you would structure the portfolio. In terms of quantum, you can start as low as $1. You can buy $1, $1 each. So $4, you can get roughly, look at what all of us have. You've got $4, not including trading costs. Phillip Securities, I don't know what your trading costs are. Could be free, right? But with $4, you can get a diversified portfolio already, right? So those are the 2 points. And then quantum is just, so then it goes again back to the spectrum again. What's your earning power? Have you put aside, your for basic needs, your insurance, etc. And then out of disposable income, after buying something nice for yourself, whether it's chocolate ice cream for dessert, right? And then another portion to investments. And as you grow older, right, your earning power becomes bigger. Then your war chest starts to grow, and then but the percentages, how you allocate is still roughly the same.
Thanks, U-Jin. I'm just quickly move on to, unless someone have more advice to add, I'm going to quickly move on to the one more question, which I thought is rather interesting. At what age should I start investing? is 50 years too late, 2 years old too late, right? Maybe I'll give this to Rafael because I know Rafael has been doing a lot of face-to-face client or engagement in his course of work. So what would be the answer to this question?
Okay, so I think thanks Wei-Jin for this question. Prior to the fund management industry, actually I was a privileged banker. So some of these clients, some of them within in the privilege segment, I get access clients which are slightly of an older age group. Whether is it too late or not, I think at the end of the day, you have to ask yourself, what stage of life are you in at that current juncture? Are you still working or are you looking to retire? And also, perhaps at the age of 50, how many years down the road do you intend to retire? Then that will set your current investment goals. And also, during your years of retirement, how much of it would you want to keep for your next generation? All these have to come into mind because you're not just planning about the investment spectrum. You are thinking about preserving wealth for the next generation as well. So there's some legacy planning involved. So you have to understand within the next, maybe if you are talking about 50, if let's say you want to retire at 65, then your runway is 15. There's a good 15 years for you to still build your war chest before you move on in life. So it really boils down to what do you want to do during that period of time. If you ask me, is it 50 too late to invest? I say, if you still have 15 years down the road before you really retire, then I think, does that make any sense to you that is it too late? And if let's say someone who has already invested earlier on in their life, they want to retire at 50, then I would say that I'll probably you have enough and you can retire. Yeah.
And I think also one thing to note is about diversification, because we have covered a few asset classes, including by Teck Ling, he mentioned gold ETF earlier on. I think each of these asset classes, if you know, they do have some way a lower correlation across them. And there's also a rule of thumb where if you're closer to your retirement age, your allocation to equities may want to be lower, right? Because equities over the long run, it could be, or rather in the short run, it could be more volatile than bonds. Any other add-ons from maybe Teck Ling? You have something to
nothing to add to that previous question, but I was just looking at some of these questions.
Sure,
here,
go ahead.
And I thought at least for those that more factual ones, I can try to
Why not?
answer them, right?
Yeah.
So one of them is I'm new to investing. If I want to invest in some of the ETFs covered, do I have to open a POEMS account? Do I need to pay more for a financial advisor? So you can open an account with any broker, even though it's Phillip Corporate ETF day today, but you can open an account with anybody to invest because it's traded just like a stock, right? So, you know, it will be, so when you buy the ETF, it will be custodized. Depending on the arrangement, it can be custodized with that broker or it's custodized with the CDP, right? Or SGX, CDP under SGX. So second part is, do I need to pay more? Yes. If you want to have a financial advisor, typically ETF and stocks, it would be a remisier. Usually it would be not so much a financial advisor who would guide you on unit trust more. Yeah, but typically, like if you get advice, typically you also would pay for the advice. Yeah, so there are products such as wrap accounts, right? For example, where basically you pay a fixed fee for the advisor to advise a portfolio of ETFs or securities or unit trusts for you, right? So then they get compensated a percentage of the AUM, assets under their management. For example, that's another model, right? Yeah, so that's one question. The other one I saw was on CPF, right?
CPF OA,
can we buy, can they buy ETFs with CPF OA, right? So as far as I remember, there are just a couple of, say, 4 to 5.
Yeah. For now, there are, I can take this one. There are 6 of them today.
Yeah.
There are 2 STI, 2 bonds. There's a gold ETF and there's a REIT ETF. 4 of them are from Nikko Asset Management, incidentally. So we do, but there is certainly plan, I suppose, from issuers to expand the list. So probably in due course, there will be a longer list of ETFs on the list.
Yes, probably. The professionally managed funds or unit trust that you can buy with CPF OA is probably a few hundreds or a few thousands.
So I think, yeah. There's one on TER, and in fact, a few of them, right? One of them is, would a lower AUM ETF cost more in terms of TER? What's the average TER for most of the ETFs? So I think for this, we do have probably a couple of ETFs that are smaller scale, but not extremely small. We are seeing 10, 20, 30 million. Whether or not you have a higher TER really depends, but we do have quite of them. I think there's always intention at some point for issuer to cap the fees. So there were several of them that with fees cap. When those are capped, then you have a peace of mind that your fees won't go higher even if the AUM is lower. I think we should be almost covered most of the one with good votes, strong votes. Maybe just to end off today's session, any final advice from each of the panelists, and also what are the pitfalls? So assuming someone is ready to start into investing ETFs, maybe one or two things that they should always bear in mind. Maybe start off from Rafael and we go down from there. Yep.
Yeah, so I think for ETFs wise, everyone is pretty much familiar with because of its simplicity and index methodology. But as you know, why we compare unit trust and ETF earlier on, I think ultimately it boils down to the index methodology that makes the ETF alive. All right. So if does the index make sense to you? If it does and represents your investment objectives, then I think there's something that you need to accept it. And also, I think while investing in markets, always do bear in mind that there will be risk involved. Yep.
Yeah, I think I think there was a question, is 50 too late to start? We have also had questions, is 25 too early? I think my advice is, if you have not started, it's easy to start. It's also very low cost to start. As I said, with $4, excluding trading costs, you can access to all ETFs generally, and that really starts you on a fairly diversified portfolio. And the good thing about it is that you literally have now skin in the game, and this is where you yourself will be motivated to learn more about all the products that we have, the ins and outs, whether matcha is better for you, plain vanilla, whether it's Chinese tea for it. But just using the analogy, right? Once you've got skin in the game, it becomes so much easier for you to learn more, to learn exactly what is good for you. And this goes into something we've not touched about, compounding. You start early, right? This gives you, as I said, a much longer runway for you to learn and for you to get better. And eventually, if retirement is your end goal, right? Have a good, safe, robust retirement nest plan for you at the end.
Okay, for me, first, I want to thank everyone for listening to Wu-Yue-Tian today. We have 5 people here. So the Wu-Yue-Tian of the ETF industry. So, and next also, so if I were to restart my investment journey, I think the key would be actually, it's not about timing the market, but about time within the market. So because of this, that is where regular savings plans, for example, like POEM's share builders plans come in to be able to allow dollar cost averaging, which is an important approach because you smooth out the volatility and smooth out your entry price by putting a small amount every month in every period to smooth out the entry price. And then the next approach would actually be about doing it in a core satellite approach. So it sounds cheap, but you think of, you go for a regular meal, you have a plain rice. But if you want something that is more tasty, maybe you have a mapo tofu to be able to increase the spice and also the variety. So in terms of the core, it would be something like a plain rice. You need a staple. For example, something that is broad-based, well diversified. And the mapo tofu can be something that is adding more potential returns, potential upside, but also potentially greater volatility. You can choose how spicy you want it. So this is the approach to key things, dollar cost averaging through regular savings plans, and then adopting a core and satellite approach. Rice plus mapo tofu, spiciness, you choose it. Thank you.
Yeah, for me, I just sort of echo what Rafa was saying. I think it's important to understand, if you're buying a certain product, whether it's ETF or unit trust or whatever, just take a bit of effort to understand what the product is trying to do, right? Like for the ETF case, what is the index, how it's built and what it's trying to build towards, and maybe understand some of the key components of that ETF, the index. Then I think it will help you to be a bit more convicted in holding steadily, for example, through a cycle, right? Because you understand it. So because understanding helps you to have greater conviction. Yeah.
Thanks, Teck Ling. So with that, we have came to the end of today's panel. So maybe give a round of applause to our panelists today.
All right. Thank you for the 5 panelists. After the, or maybe when they're making their way off, I would like to add on one thing as a host and as an employee of my firm, right? I must mention, ETF trading, just in case it was not particularly mentioned, there is no minimum commission on the Poems platform. So feel free to open the account with us. Even regardless of account type, there's no minimum commission for ETF in Singapore. All right. Also, the lot size is only 1 share, like what mentioned by U-Jin. So fairly easy to invest. Can be below $1, slightly more than $1. I think the most expensive ETF you should see might be the Gold ETF, right? So that's the 2 part. All right. So thanks to the panelists for sharing their views and everything. So next part, all right. We will have the end for the online sessions. All right. Then there will actually be I think the recording on YouTube. If you want to revisit the sessions, even for the physical attendees, if you forgot certain segments, you want to revisit the session, feel free to go to YouTube to see the session again. All right. You can also put in your comments or share with us, but I don't think we answered all the questions. You can also ask questions to your trading rep or your party involved that you are aware of in our company.